If you look at the labor market, it's been on that cooling trend for the past 2 years.
I don't know the degree to which the market is going to weigh job losses in the federal level.
I don't see the unemployment rate rising.
It may be all told that the negative hit to employment is slower to unfold.
We have an economy that is fully employed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, going into the payrolls report, markets poised for the biggest weekly loss of the year so far. And the president, he's not even looking at stocks.
I'm not even looking at the market because long term, the United States will be very strong with what's happening here. This is something that we have to do. There'll always be a little short-term interruption. I don't think it's going to be big.
Lisa, what happened to the Trump put?
That's actually at the top of my notes this morning is the Trump put debt, because essentially that's what Donald Trump was saying yesterday. I don't care. That's not the story. Long term, this will be great. This is what the market has been picking up, that for all the turmoil, there isn't necessarily going to be the relief valve of Donald Trump coming to the fore and just simply getting with a more predictable policy. That said, yesterday did give a sense that this is going to be an on-again, off-again type of tariff negotiation and not necessarily a linear direction.
That's exactly right. Trump said those automakers right now that are getting the exemption and some other products, it's not going to last. There's not going to be another pause. They're really looking forward to April 2nd. And not just the president saying, I'm not looking at the stock market, although you have to think he's peaking a little bit. Scott Bessent yesterday, the Treasury Secretary, speaking at the Economic Club, they are still squarely focused on where yields are going and also where oil prices are going. They want lower energy costs and lower rates.
We can get a sneak peek of the equity market right now. Equity futures firmer by 0.2% on the S&P 500. On the Nasdaq 100 up by 0.4. The main event later this morning, 8:30 Eastern Time, the payrolls report. And then later on today, Lisa, you'll hear from Chairman Powell.
Which is going to be a very interesting moment at a time where there is peak policy uncertainty. I believe that Deutsche Bank put it as policy in a dark room. That's certainly what's happening over at the ECB. There is a similar kind of feel over at the Federal Reserve. Chris Waller came out yesterday, had some very interesting things to say, that basically 80 to 100,000 new jobs was about neutral, keeping even, lowering the bar, and then going on to say it's reasonable to see 2 more rate cuts this year. And you know what? Things are still very restricted.
He's running. How many times have we said that about Governor Waller going for Chairman Powell's seat?
Honestly, you can't come out with a way to explain weakness as not being weak and justify more cuts as just a general disinflation than what Chris Waller did yesterday.
It does sound like he's auditioning. When it comes to the jobs report today, though, a lot of focus is going to be on what is happening with the Trump administration when it comes to DOGE. Now, most economists think what happening with DOGE will not show up in this print, but what they will say, like Citigroup, primarily they think what can be reflected is the federal unemployment freeze that happened in January. How much are we going to see weakness in the report because of that freeze that happened at the start of the Trump administration?
The estimate in our survey, 160. The numbers drop at 8:30 Eastern Time. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, with stocks poised for the worst week of the year so far. Francis Donald and Elsa Linos of RBC on the state of U.S. exceptionalism, and Sarah House of Wells Fargo counting down to payrolls. We begin this hour with stocks on track for the biggest weekly loss of the year so far, after a fire hose of tariff headlines whipsawed financial markets worldwide. Cameron Dawson of New Edge Wealth writing, we expect this period of market volatility to continue, even if we get a bounce in the near term off of long-term support and oversold levels. Cameron joins us now for more. Cameron, good morning.
Good morning.
Why do you expect this to continue?
Because we came into this year with such high valuations, such stretched expectations, that there still is very little room to absorb any kind of bad news. And so our view has been expect volatility, get used to volatility, simply because there's no cushion, no margin for error. So we do think that you are slightly oversold. You are set up for some kind of bounce in the near term. But what we're really watching for is how do we deal with that overhead resistance? We think that's around 6,000, and we see a rising risk that we roll over at that overhead resistance, that we don't have the V-shaped recovery like we had in 23 and 24.
Headline of the week, the president, I'm not even looking at markets. What happened to the Trump put?
Why would we think that the Trump put has a strike price at today's valuation and not lower? Right. We do think that in order for Trump to act and say that and pull back on some of the rhetoric, that you'd actually have to see much more volatility in stocks. We're only down 7%. We're about where we were prior to the election. So we think you'd have to see much more pain in stocks for him to actually step in, say things that could be supportive for markets. But don't forget, even a year like 2018 had a peak to trough decline of 20%. So where was the Trump put then?
So 5,400, you're basically saying the Trump put's just a lot lower than people expected. Is that right?
So we do think that if you roll over at that 6,000 level, that 5,400 is in play. That does not mean that you can't be a buyer of today's weakness. We did some work in looking at volatility once you go under the 200-day moving average, that if you look at 1 year and 3 year, you get much better forward returns. But you can expect further downside once you cross below that 200 days. So again, it's a matter of just staying in this volatile period, which we think that we can take advantage of to the downside, but certainly is something that's not going to be in the rear view.
I got a little carried away yesterday. I was talking to a lot of people and I was thinking, wow, this is, potentially the end of the U.S. exceptionalism trade, like Bob Michael of JP Morgan Asset Management was talking about, and the beginning of European exceptionalism. And all of a sudden you've got fiscal investment. And then I went out and talked to a couple of corporate executives and investors, and they said, we're still going to work every day. And you know what? The companies still look pretty good. And you know what? People still have a lot of money to invest here in the United States. Have people gotten over their skis with this story?
I think to an extent, because if we think about U.S. exceptionalism coming to an end, it brings to mind the period of 2000 to 2007. That was the last time that you had a prolonged bull market in non-U.S. stocks that persisted. In that time, you had a 40% peak to trough decline in the U.S. dollar. So we're not at the point yet that we're willing to make the call that the U.S. dollar is going to fall that much. But it does raise the question of, do you see shifting capital flows? I don't know if I would equate Germany rearming or spending more in defense to China industrializing like we had in 2000 and 2007. So we do think that maybe we're a bit far over our skis, but certainly this is a shift at the margin.
It's a sentiment shift, that's for sure. And it's the reason why people have been placing more emphasis on negative data prints. And we have seen that with both earnings and we have seen that with economic data, where suddenly that is the trend. Do you think that persists, or do you think that that's already kind of played out and people are going to be a little bit more sanguine?
Well, one of the reasons we think we're seeing today's volatility is that for the last 5 months, you've been cutting earnings estimates, but stocks have been going up. So you've been seeing stocks go up on PE multiple expansion alone for the last 5 months. That created a fragile environment to see more volatility. So if you continue to see earnings estimates get cut, if you continue to see economic surprises go into deeper negative territory, then yes, the volatility continues simply because you are not calibrated for the growth rate. At the end of the day, we are in a lower nominal growth environment than we have been in the last 2 years. We see inflation decelerating, we see real growth decelerating, which just translates to lower returns for risk assets.
Lisa, to your point, just to build on that, Neil Dutter of Renmac this week, the fact that stocks are getting whacked even though tariff headlines show Trump backing off is a towel. That means the market either believes the threats of tariffs have already done enough damage than actually going through with them, and or the underlying economy was already sliding. This is the problem going into payrolls later this morning. Do we believe strong data? Will we just look through it?
That's the reason why I'm curious whether there continues to be this bias toward negativity in the data, and positivity is considered previous administration's data. I mean,
Biden data.
Biden data versus Trump data. Is this the past or is this the now? And whether people have this feeling that maybe the uncertainty is the now. That said, when you take a look at the earnings, they're not all that bad. So it's hard to really come up with a consistent narrative.
ISM Services was pretty decent as well. But we're not talking about that. We're talking about ISM manufacturing, consumer confidence. We're talking about the weak stuff.
And if you take a look at the Citigroup U.S. Economic Surprise Index, it's actually inflected less negative over the past couple of days. So it's not clear that this is a linear trend, even though the narrative has shifted.
8 minutes into the programme, Lisa on the edge of bullish.
No, well, hold on. let's not get carried away. I'm just trying to provide a counterweight to, the mainstream argument.
Cameron, 8:30, the estimate's 160. How would we respond to stronger than expected economic data?
Yields up, certainly. That's where we would expect to see the bond market, which has been most resolute in pricing.
We'd latch onto it, we'd believe it.
It's a really good question, because what we do think is that there's still all this volatility, that expect the unexpected in this data, because we have seasonality, we have questions around what gets included with Doge. But I do think that if you don't show signs that the jobs market is falling off a cliff, then that just means that some of this pricing of lower bond yields, which has been so sharp over the course of the last couple of months, could potentially reverse.
Most economists don't think that Doge gets priced in for this report. It's more the hiring freeze. How many jobs do you think that is, base case?
Look, we don't know at this point, because we also know that there is a expansion effect of, it's not just the Doge cuts, but it's the uncertainty. How much do contractors pull back on wanting to hire more people? And so we think that that uncertainty factor is what causes this potentially to be a much bigger impact to jobs over the course of the next couple of months, but it remains incredibly and wildly uncertain.
Cameron Dawson of New Edge Wealth will be sticking with us. The jobs number drops at 8:30 Eastern Time. The range in the estimates is wild, really wide. The high is 300K, the low is 30, the median is 160. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is delaying some Mexican and Canadian goods covered by the North American trade agreement from his 25% tariffs. That includes items like autos and certain fertilizers. The duties are now expected to take effect on April 2nd, when Trump is also set to unveil reciprocal tariffs. Hungarian Prime Minister Viktor Orban said the European Union cannot afford to finance Ukraine's military efforts in an attempt to slow the country's EU accession. At the same time, French President Macron said that the region needs to boost defense spending, while President Trump has said that the U.S. might abandon its NATO commitments if member countries don't meet defense spending targets. SpaceX has lost its second Starship rocket in less than 2 months. The rocket split apart as planned, but the spacecraft began tumbling and lost contact with mission control at around 8 minutes into the flight. Starship is key to SpaceX. CEO Elon Musk's dream of sending humans and cargo to the moon and Mars. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. The moves this week in financial markets worldwide have been phenomenal. Stateside, looking at the worst week of the year so far for 25 on the S&P 500. Over in Europe, a 40 basis point plus move on a German 10-year yield. And in the FX market, the euro up more than 4% on the week against the US dollar. The biggest week of euro strength going back to 2009. Up next on the programme, we're questioning the Trump put.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones. I'm not even looking at the market, because long-term, the United States will be very strong with what's happening here.
The president isn't even looking at the stock market. We are. Tyler is too. Tyler Kendall joins us next. Equity futures on the S&P positive by about 0.25%. On the Nasdaq 100, we're higher by 0.4. We're down on the week and down quite hard. We're negative 3.6% on the week so far on the S&P 500. Potentially, and this can change, potentially the worst week going back to September of last year. David Costin of Goldman Sachs writing this morning. We believe washed out positioning or an improvement in the economic data will be required for the recent rotations to reverse. We'll get more economic data later this morning at 8:30 Eastern Time. The jobs report just around the corner. 160 is the estimate in our survey. Under surveillance this morning, we're questioning the Trump put.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones on relatively small, although it's a lot of money, having to do with Mexico and Canada. But the predominant tariffs will go, they'll be reciprocal in nature. I'm not even looking at the market, because long term, the United States will be very strong with what's happening here. This is something that we have to do. There'll always be a little short-term interruption. I don't think it's going to be big.
So here's the latest this morning. President Trump saying he's not checking markets after granting Canada and Mexico a temporary reprieve on tariffs. Trump exempting levies on goods compliant under USMCA until April 2nd. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, a subtle shift for the president.
Right. Well, John, when it comes to these USMCA exemptions, a senior administration official briefed us reporters yesterday and said that if Canada and Mexico continue to make progress towards President Trump's border policies, then actually the goal here is to see that batch of tariffs lifted ahead of April 2nd, where we are expecting those reciprocal tariff plans to be announced, as well as a host of other tariffs on different industries, such as chips, autos, and pharmaceuticals. Importantly, on autos, John, yesterday in the Oval Office, President Trump said that the big three automakers did ask him for a more extended reprieve, and he told them no. If we look at just the USMCA compliant data that we're going to be watching, the White House says that about half of the goods coming from Mexico, 38% of the goods coming from Canada will likely be USMCA compliant. So still a big part here that will be subjected to tariffs. But it's not so easy to pin down the data. And I'll tell you why. According to Bloomberg Economics, last year they estimated that anywhere between 44% and 84% of goods that came in from U.S. and Mexico were USMCA compliant. And why that range is so big is because some goods might be compliant, but it doesn't mean that they applied for the exemption, because it's often could be cheaper or easier to apply for a different exemption, such as the so-called most favored nation rate. John, a lot of numbers here, a lot of uncertainty still, but the one through line, at least from this White House, is that they still say that this specific batch of tariff policies are tied to President Trump's border priorities, even as our allies, Canada and Mexico, say they've done almost everything they can to address the White House's concerns.
Tyler, it's a fantastic point, because you're going to see a barrage of companies really try to make sure that they now become USMCA compliant and apply for that. When it comes to the concessions we've seen from Canada and Mexico, do you think it's enough for this president?
Well, at this point, the White House's indications is that it is not. According to that senior administration official that briefed us, they think that any amount of fentanyl coming over the border is too much fentanyl coming over the border, even as we've seen, for example, Mexico surge troops up to the U.S.-Mexico border there. And to your point about these kind of broader impacts that could potentially shift this White House, for example, Bloomberg News reporting that some executives from fast food companies, including McDonald's and also the parent company of Taco Bell, actually went to the White House this week to warn officials that there are going to be pretty widespread impacts on their industry. And that it could be one example for this recent trend that we're actually starting to see here in Washington, which is congressional Republicans getting a little more comfortable with sounding the alarm bell. Senator Shelley Moore Capito, Annmarie, a Republican from West Virginia, one of the states with the highest rates of overdose deaths in this country, was on Bloomberg Television's Balance of Power this week. And she said that she's largely, of course, in favor of this batch of tariffs, but that ultimately she sees President Trump asking for patience when he talks about this adjustment period, but that patience is going to start to run thin if we do see prices hike.
Tyler Kendall, the latest down in Washington, D.C. Tyler, thank you. I'm very intrigued to know whether Mexico and Canada are aware of any metrics provided to them over the last month or so, going into this month, to avoid what could happen early next month.
Well, the problem is that they thought that they would be able to get a carve out immediately with all these concessions. They didn't. We did see these tariffs go on place for 48 hours? And the problem is the president says there's not going to be another pause. And April 2nd, they will go line by line, item by item, and map out what the reciprocal tariffs are going to be, not just for Canada and Mexico, but the rest of the world.
There's a comment that Lisa made earlier this week that stuck with me. And it was equity strategists who were afraid to downgrade their outlook for 2025. Economists are brave for that matter, because they are downgrading their outlook for 2025. Barclays have made their move. This came from Morgan Stanley and Mike Gapin just overnight. We take on board greater than expected intensity in trade policies and revised growth lower in 25 and 26. We now see higher inflation in 25 with a more pronounced and sooner reacceleration in goods prices. The mix of firm inflation and low unemployment could put the Fed in a bind. That's going to be the big focus for the next few months.
Especially because companies don't have the ability to turn on tariff adjustments on and off like a switch. They have to make adjustments in the meantime to protect their businesses in the many different lines to offset any potential changes in policy. And you're seeing that. You're seeing those adjustments being made in the earnings that are coming out, whether it's Gap talking about a 10% adjustment in certain places last night, or whether it's what we heard from the Home Depots of the world and the Walmarts of the world. So these are the ways that companies have to gird for it that reduces dynamism, even if these tariffs don't ultimately end up in place.
Cameron Dawson of New Edge Wealth still with us. Cameron, March 19th, the Federal Reserve meets. Two-day meeting concludes. They put out forecasts. What's that meeting look like?
Well, we think that they're still very much on hold because of that uncertainty of how these tariffs and potentially immigration could feed into the inflation story. And we don't think we'll get weak enough data yet out of the jobs market to justify them acting. Now, it's a really good question of how the SEP changes. Will we see them downgrade growth forecasts as we're starting to see the street do? I think that that's a really interesting mode shift from the world that we've been in over the last 2 years, which is that every single month over the last 2 years, we've been raising GDP growth forecasts on a consensus basis from Wall Street. Does that start to change? And if we start cutting forecasts in the other direction, that to us is what keeps this volatility within equity markets and within credit markets around.
Yesterday, the Treasury Secretary Scott Bessent, speaking at the Economic Club of New York, talked about tariffs being a one-time price adjustment. He said, yes, that's true. And he hopes that what he calls Team Transitory starts looking at that as a one-time price adjustment when it comes to inflation. But if you're a company, are you more worried about inflation at this point or actually weak growth?
Yeah, I mean, we heard from the Fed Beige Book that they are having trouble. Companies are having trouble passing on price increases to consumers. So if they're able to pass on those price increases and consumers accept higher prices, that's where tariffs actually could metastasize and become a larger inflationary driver. But if consumers are pushing back, they're not accepting price increases, they're pulling back on consumption instead, that would suggest that there's more downside to growth. It's not about inflation, it's about weaker demand, and that is something that would then show up potentially in the jobs market eventually.
To get a fuller view, though, of the Trump administration's policies, we have to see the tax cuts. Would you change your outlook on where equities are going once we get the policies out of Congress?
We are not optimistic that you're going to get incremental tax cuts, that you just get an extension of the taxes that are already in place or the policy that's already in place. And if we think about the pay-fors, that's a really interesting question of do you get tax cuts if you try to go for that on the corporate tax side of things? How do you actually pay for that? And if it's being paid for by doing things like formalizing tariffs and making them permanent, which we would see effectively as a consumption tax, we would see that more as growth negative than the benefit you would get from a lower corporate tax rate.
This is mind spinning. It's super fun. We're all going to enjoy it for the rest of the year. What do you do with this?
I think that you continue to be in a stance where volatility is still your friend to the downside, where you can take advantage when names start getting sold indiscriminately. You stay high quality. You don't chase low quality names. We do think that you are going to remain in these wide choppy ranges for equities, for fixed income as well. We don't think that you are pricing in any risk of downside to growth in credit markets. So we do think that areas like high yield remain very, very risky for that potential shock. But I think that you keep your head down, you continue to focus on the fundamentals and companies that have strong track records of blocking and tackling through uncertainty.
So to be very clear, you're not assuming actual regime change, that this is going to be a lot of noise, but it's not going to be a seismic shift overnight that's going to fundamentally adjust entire sectors and their profitability prospects.
We think that there's a very big difference between falling into a recession and collapsing growth versus decelerating growth. We're still in the decelerating growth camp because we still see strong underlying drivers for this U.S. economy. We still see strong underlying drivers for technology investment. However, we don't think that this is the same world that we were in 23 and 24, which means no V-shaped recoveries and higher volatility.
And it's happening at a time where the outlook seemingly is improving over in Europe and in China too, which could trigger some real outflows from U.S. assets. Does that make this period just a little bit more riskier?
We do think that that's what brings back that 2000 to 2007 kind of memory, which is that you saw big outflows out of the U.S. after you had a period of peak concentration in markets, a very strong technology story. And that raises the question of how much downside is there still in U.S. valuations? You're still trading at 21 times forward earnings. Now, that's down from the 22.7 ceiling that we hit at the beginning of the year. But we think that because valuations are still so high, Because positioning is still so crowded in the U.S., don't be surprised if there's more air to come out.
Cameron, appreciate your time. As always, thank you. Cameron Dawson there of New Edge Wealth. We've said repeatedly on the programme so far this week, it's the most exhausting 6% pullback we can remember. It's been decades, maybe. And I think the reason for that is the damage done elsewhere on some major names. To see Nvidia down 11.5% on the week, that's a $350 billion market cap move. We've seen some big names that a lot of people hold take a lot of damage.
Which is the reason why people feel exhausted and question what the put moment is. I just want to note, you said exhausting. Yesterday marked the 6th session in a row that the S&P 500 moved more than 1% in either direction. That is the longest such run going back to the pandemic in November 2020.
The big question is Trump just joking when he says I'm not looking at the stock market? But Neil dotted to your point earlier, his note, he said he thinks the U.S. administration is pleased with what they're seeing. Dollar down, oil down, rates lower. Stocks have sold off, but it's not a disaster.
Crude at the lows for the year. It's what they wanted. I'm not sure if it's by design. Up next on the programme, Francis Donald and Al Salinas of RBC counting down to payrolls. From New York City this morning, good morning to you all. The payrolls report 2 hours away. Lisa said it just moments ago, 6 consecutive sessions of 1% moves in either direction over the last week or so. Just absolute phenomenal volatility we've seen at the index level. Equity futures right now firmer by 1/3 of 1%. The Nasdaq 100 up by 0.5 on a Russell, up by 0.2. The fate of this market in the hands of Chairman Powell later on, and a payrolls report this morning at 8:30 Eastern Time. And no doubt some comments from the President of the United States. So plenty of volatility, potentially. Let's get to the bond market, the 2-year, 10-year and 30-year. We have had a run of 7 consecutive weeks of lower yields on a 10-year maturity. We're about to snap that this week. The 10-year 426.47. Lisa, that can change at 8:30 Eastern Time.
Yeah, it depends on how much we end up getting a hotter than expected print. And does that upend the narrative that we've been having, which is that the U.S. economy is quickly deteriorating and we're seeing this weakness come in that we haven't seen for a long time. If that gets challenged, how offsides will this market now be after a couple of weeks of that kind of activity to see a pretty big snapback the other way?
Talking of a snapback the other way, let's check out Europe, because you've seen a major snapback the other way on the euro, on German 10-year debt. Yields this morning basically unchanged at 283. We've had a move of more than 40 basis points higher on a 10-year maturity. In the FX market, the euro seems to move one single figure every single day. Euro dollar having a look at 109, at 108.50 and positive 0.6% on the session, on the day. On the week, up by more than 4.5 percentage points. The biggest weekly gain for the euro potentially since 2009.
The calls coming out of Wall Street firms have been just jaw-dropping in terms of just completely rejiggering their takes on this year as a result of some of this fiscal spending. Bank of America's Michael Hartnett came out and he said that he wouldn't be surprised if German Bund yields, if 10-year German Bund yields were trading above where 10-year U.S. Treasury yields were by the end of this year. That is a bold call at a time where there still is almost a 1.5 percentage point gap between the two.
They've already converged a lot already this year. 10-year yields lower in the United States and Germany coming up very quickly. On our radar this morning, check out shares of Broadcom. On track for their biggest gain in 12 weeks. The chip supplier for Apple giving an upbeat forecast, reassuring investors that AI spending remains healthy. Their stock is up by close to 11%. This was an important number because we have been spooked a number of times over the last month on the AI front.
Yeah, and this is the reason why people were so focused on this. And I mean, just overnight, we also got HP, which came out and people were very nervous, and you're seeing those shares lower in a significant way. It gets to this complicated place. Are we seeing new winners and losers? And is it really idiosyncratic, depending on the company, the application, who their customers are, Apple, to figure out whether or not they are going to make these gains or not? It's the reason why it's a complicated story right now, and the reason why you're seeing massive swings in the likes of Nvidia.
We've also got to think about chip restrictions as well, which no doubt is going to be a bigger story as the year progresses, and China is in the mix with regards to that. China's saying this morning, the foreign minister calling President Donald Trump's tariffs evil and arbitrary, saying the levies are two-faced and not good for the stability of bilateral relations. I'd say that quote's probably not great either.
Well, no, definitely not. And also, when you think of two-face and what China has done in the past in terms of their policies, they should also potentially look in the mirror. When it comes to what they are saying, though, they seemingly seem to be calling out Trump when he talks about that he has this great relationship with Xi Jinping, and he says that Xi Jinping is brilliant. Obviously, the president publicly wants to maintain these diplomatic times, I mean, Olive Branch, I think at the end of the day, he might want a big, beautiful deal when it comes to China. But when you hear about reprieves and exemptions when it comes from tariffs, there's nothing when it comes to China. That 20% is in place, and there's no talk of rolling it back.
I just wonder how far resentment goes when it comes to international relations. I know how far it can go in personal relations, but there's a question about international relations.
Tell us more,
Therapy time.
Justin Trudeau coming out and saying that he expects a trade war between Canada and the United States is expected for the foreseeable future. It's not just the leaders. It's also the people of these countries. And I wonder how much we end up seeing that in their preferences for products going forward. We've seen that on the margins with Tesla, maybe, depending on whether you believe that. Do we see that in others as well?
I'm pleased you brought this up. Sitting here in New York, being in the United States, I'm not sure we're quite aware of how offended the Canadians actually are right now north of the border. And you can really feel that sentiment starting to build.
If you go to a hockey game with Canadians and they start booing the national anthem and they start booing the American flag, it gives you a sense. These are Canadians. They are so kind. They generally are really welcoming to U.S. members.
They boo and then they say sorry.
Yeah, I mean, honestly, they leave their doors unlocked. They're lovely.
It's not just Canada. In Mexico, Claudia Sheinbaum is being known as the Patrona de Mexico, the patron saint of Mexico, because of how she's dealing with Donald Trump. And her poll numbers throughout this whole fiasco have gone up, something I think any public official would be jealous of.
Yeah, big change for Trudeau's party as well. The Conservatives had a massive lead as of a couple of months ago. We've seen that really narrow over the past few weeks. President Donald Trump saying he's directing cabinet secretaries to use a, quote, scalpel rather than a hatchet when making federal workforce cuts. The move suggesting maybe on the margin that Trump is looking to shift some power away from Doge.
I think a lot of this is stemming from what's happening in Congress and a lot of Republicans, whether or not you're a senator, you're a congressman or woman, you're calling and you're saying, I'm getting a lot of calls about this. Are you being precise? Why does this feel like it's, causing a lot of havoc and chaos? Trump in this truth says, as secretaries learn about and understand the people working for the various departments, they can be very precise as to who will remain and who will go. He says they want to keep the best people. So now it sounds like they're taking a step back and being a little bit more methodical about how they go and Dogeify the government.
So that should give some more clarity to today's jobs numbers and what you can expect going forward.
Absolutely not.
Payrolls 2 hours away, 8:30 Eastern Time. It's going to be an important read. We'll find out how soon those numbers start to move off the back of the Doge effort. Let's stick with the economy. Francis Donald of RBC writing the following. Whereas the Trump administration was initially celebrated for its emphasis on deregulation and tax cuts, it is now facing tariff-centric policy and fiscal pullbacks, which is not reflationary but stagflationary. Joining us now, two of the very best, Francis Donald and El-Erian. Francis here in New York, Elsa over in London. I just think the perfect pairing for this morning, because we're talking about the end of US exceptionalism, and that has a big FX impact that we can talk about with Elsa shortly. Francis, I want to begin with you. What's changed in the past month?
Well, when we talked about U.S. exceptionalism, let's remember that it was generally a call on the structure of the economy, which was really being supported by fiscal, CHIPS Act, AI, good underlying fundamentals, and the cyclical acceleration. I don't think the structural story for the United States has changed too much here, but that cyclical optimism is what is fading at this point. And we are seeing the damage from tariff uncertainty creep into the sentiment surveys, creep into soft data. What we need to see now is, does the soft data bleed into the hard data, especially with this K-shaped economy where the ultra wealthy have been supporting the whole? And what concerns me most as well, we heard from President Trump, we heard from Secretary Bissett that they're not watching the stock market anymore. Maybe if they're watching the economy, they need to be aware of that wealth effect flowing through. The other component of this, which is hugely important, is just how inflationary those tariffs turn out to be. Strongly depends on the path of the U.S. dollar. That's why Elsa's views are so critical to the economy now. It's not just economy to FX, it's how FX will change the shape of tariffs and just how stagflationary they are.
Which, Elsa, is a reason why a lot of people expected that a strong dollar would offset the inflationary aspects of those tariffs, exactly to Francis's point. And yet what we've gotten is exactly the opposite. And it's part of what's going on with growth fears in the U.S., but it also has to do a lot with what's going on in Europe. How far can that dollar weakness really go?
Yeah, absolutely right. It's been an absolute momentous week for Europe. I mean, the scale of integration and large-scale announcements we've heard this week just pales into insignificance compared to anything we've heard over recent years. So I think there are a number of cross-currents. As you said, there are a number of people saying, well, actually, a stronger dollar could offset the impact of tariffs. I disagree with that. The large majority of U.S. imports are actually denominated in U.S. dollars. So a lot of that effect would actually accrue to exporters in terms of profit margins. But thinking more generally about where the dollar goes from here, as I said, we have a number of cross currents because it wasn't just the fiscal announcement coming out of Europe this week. It's also the fact that we already had better European data. We saw that again this morning with the upgrade to Q4 GDP. Actually, the economy did reasonably well. From initial reading that was 0.05, barely better than flat, up to 0.22 now, with a lot of that coming from domestic demand. And so I think it's that challenge which has caught people off guard. How much further can the dollar run? I mean, you know, we've been eyeing up 112 as a decent first resistance level just because that's the level we got to in September of last year when, again, there was that pessimism about U.S. exceptionalism.
I miss the days when we were talking about growth differentials and inflation differentials, and we could just focus on that. Now there's tariffs. Now there's questions about spending. Now there are questions, all of this. To Francis, the point, if you try to strip it down, which is kind of the goal right now, it's just growth and inflation. Which is the biggest lever to pay attention to when it comes to the U.S. rates outlook, when it comes to just how much these tariffs could really affect the U.S. economy?
Well, it's a great question, and I'm glad you qualified for the United States because it really differs depending on which country you're looking at. In the United States, they have some growth margin. We were looking at 2% growth for 2025. If we have to downgrade to even 1%, I mean, it's not a great development. You have to have a re-rating across many asset classes, but it's not going to break the U.S. economy. Where there is very little room is on the inflation side. And if we do see these 25% tariffs come through 1 month from now, we could be seeing 3% core inflation by year end. And combine that with a structurally tight labor market, it's not a great position to be in for the Federal Reserve. High inflation is going to be what it becomes more problematic for the American psyche right now, especially because, let's not forget, prices are up 29% since Trump's first day in office back in 2018. The appetite among households, businesses, and the market for the inflation side of the picture is very different now than I suspect the growth side.
You were at the Economic Club last night, Francis, and you heard what Scott Besson had to say. He says this one price shock is transitory. Do you think it's transitory? Do you think this will bleed through for months to come?
Well, economists and those who like to say that tariffs will not be problematic for the American people will say it's transitory. And what they mean by that is there's a one-time price level adjustment, and 1 year later it drops out of the year over year. But I like to say tariff price level increases are also permanent. So the price increases, but then it stays at that level for an extended period of time. What came out of me from that speech was that, you know, Secretary Besson described a nice economy, one where we've deleveraged from the public sector over to the private sector, one where trade is recalibrated for the American people. It actually sounds like a great economy that many economists would check the box on, but you have to build the bridge to the other side. And from my perspective, what this market is coming to recognize is that that bridge to this economy that's being described is not seamless, and it may not be guaranteed.
And might do a lot of damage in between. We started this year, and I talked about it repeatedly, we all did, that the policy mix would attract a lot of capital from the rest of the world. Is the policy mix starting to push it away? Is it too early to tell?
It's a sequencing issue. So we're not getting the juicy, high-quality, invest in American exceptionalism content first. Some of that may be just having to fund some of the better things, but there's some story that you kind of have to eat your vegetables before you get your dessert. Maybe that's a little bit of the mix that we're getting right now.
And Elsa, this is exactly the point behind a lot of the really bold calls behind euro strength, given the fact that people are seeing suddenly the sucking sound away from the United States toward Europe. How much are you actually seeing evidence of that euros are flooding in with what we just saw, the biggest weekly inflow into European stocks going back to 2022? I mean, you've just seen this groundswell.
So we're certainly seeing a huge shift in the short-term positioning. And actually on our short-term positioning monitors, markets already actually turned long euro-dollar, having been quite consistently short. But it's interesting, you know, I've seen some calls out there for this kind of continued euro strength, kind of pacing it gently throughout the course of the next 12 months. I actually think it could look pretty different. I mean, there's this initial move, which is very likely, it feels like it's going to get into overshoot territory because it happened so quickly and people are somewhat chasing the move. On top of that, you've got that equity angle that I feel is really underappreciated, the impact that has on the currency market, because we're seeing a structural reallocation out of US equities back into European equities, and there's a currency component to that as well. But once all that washes out, you know, the point Francis made is absolutely critical. is this going to be an environment where the Fed can cut rates aggressively, or is the inflationary backdrop going to prevent them from doing that? And if you don't have those aggressive Fed cuts, then those kind of calls for 120, 125 that, we got to back in 2021, that 123.50 high, that looks much harder to achieve without that convergence in front-end rate differentials.
Also, there's one piece of this story over in Europe that I'm trying to make sense of, and perhaps you can help me. We've had a massive week for the euro. I know that off the back of the plans to boost infrastructure spending. But this all started when President Donald Trump made a more aggressive push to end the war in Ukraine. That's when the euro started to move, started to find a floor. And also, I wonder if Germany is going about rearming and the whole of the continent goes about rearming, does that make war more or less likely? Because that's going to have quite an impact on the continent and financial markets.
It's a great question, John, and I think one which people have in the back of their minds. Our spot trader here in London was mentioning that this morning. Is it necessarily great for Europe if we're having to rearm ourselves with the risk right on our eastern borders? I don't think that's a story that people are focusing on today. I think they're far more focused on that kind of end of US exceptionalism and the swing in capital away from the US back to Europe. But that's certainly a risk premium that's going to be baked into the back of people's minds.
Two of the very best. El-Erian of RBC, Francis Donald here in New York. To the both of you, thank you. And later, don't miss this, about an hour from now, we'll catch up with Amy Wood-Silverman of RBC together with Laurie Calvasina. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bitcoin fell after U.S. crypto czar David Sachs indicated that the U.S. government won't use taxpayer money to fund a strategic stockpile of the digital asset ordered by President Donald Trump. Bloomberg Technology will be speaking to David Sachs. Don't miss that one, 11 a.m. ET, 3 p.m. if you're in London. A check on Gap shares. They are up 17.5% in the pre-market. It exceeded sales estimates. It saw strong results in its namesake brand, along with Old Navy, Banana Republic, but it did report an unexpected decline in the athleisure brand Athleta. The results indicate that CEO Richard Dickinson's turnaround plan is paying off. Elsewhere, Goldman Sachs is pushing managers to move away from expensive office locations. Dubbed informally by some as Project Voyage, the aim is to drive down costs and type a pipeline of talent emerging in cheaper regions. The bank is telling managers in New York and London to relocate to Dallas or Salt Lake City or risk losing their job. And that's your brief, John.
Danny, thank you. More from Danny a little bit later. We're on that story later as well. That's not the deal it used to be. 5 years ago, it'd be like, oh no, don't send me there. I love New York. 5 years later, I just wonder how many people would take that.
Big house, go skiing.
Right, lower taxes.
Exactly. I'm a New Yorker, and I saw that story, and I was like, it's not bad. It's not a bad deal.
That offer's changed. Up next on the program, Biden data.
You're looking at data that's Biden data. Do not try to besmirch my President Trump with Biden's nonsense.
The Biden economy, the Biden jobs market was way worse than markets thought.
More Biden data coming up later. We'll catch up with Sarah House of Wells Fargo in just a moment. From New York, this is Bloomberg. Jobs report later this morning, 8:30 Eastern Time. The estimate in our survey, 160K. Equity futures going into that just about firmer by 1/3 of 1% on the S&P. Under surveillance this morning, Biden data.
You're looking at data that's Biden data. Do not try to besmirch my President Trump with Biden's nonsense. What possible could change? Seriously, we are in early March. My president took over January 20th.
The Biden economy, the Biden jobs market was way worse than markets thought.
So here's the latest this morning. Trump officials blaming Biden for weak economic data. Later this morning, jobs data for the first full month under the new administration. Sarah House of Wells Fargo writing, we estimate non-farm employment increased by 170K in February. Beyond February, we expect slower labour supply growth to limit a continued rise in the unemployment rate this year. Sarah joins us now for more. Sarah, welcome to the programme. I want to pick up on that word that Commerce Secretary Howard Lutnick used, Biden data, and this line from him that my president took over on January 20th. Is it too soon to expect the policy changes to show up in the data?
I don't
don't think it's too soon to be seeing that. We know businesses are forward-looking just like markets are forward-looking. So just as we saw things, including some of the sentiment surveys, but also markets move following the election, I think you are starting to see some of this administration's policies or some of the uncertainty around those policies begin to filter in through the data. So I think it's a little bit of a blend thus far, but it's going to get harder to draw that distinction between the former administration and the current administration as we move, especially into the March data.
Sarah, how significantly did you weight yesterday's challenger job cuts? Normally, this is a data point that we don't necessarily account for, and yet it did move markets and seemed to really color people's perceptions.
Yeah, Lisa, I'm glad you brought that up because I think that was a really important report. Now, we do see the challenger announcements. They can bounce around from month to month, but even when you take out the federal government cuts that the challenger announcements included, so you still saw the biggest layoff announcements going back to 2020. So what I think that really speaks to is some of the softening in labor market conditions that we're expecting to see as we move through the year. This isn't all about reducing the federal workforce or some of the related federal spending cuts, that really there's a lot more going on, uncertainty around trade that affects goods and goods adjacent industries as well. And so I think that it is a cause for broader concern. And I think it was a report that really did stick out much more than those reports usually do.
How much does it really heavily weight, Sarah, the idea that we need to get real job growth on the other side of the equation to offset this, that maybe we could get a better than expected number today because those people are finding jobs and there are other areas of the economy that are needing to beef up, particularly domestic production in the face of tariffs?
Yeah, so I think there's a little bit of a timing mismatch here. So for a lot of those layoff announcements, they are just that, announcements. So they could take place over the coming months. Maybe some of them don't take place at all. But of course, the numbers we're looking at here today is really what we saw through the middle of January to the middle of February. So I think it's too soon to see those offsets, but it underscores that if you're going to be putting constraints on the good side of the economy, if you're going to be putting constraints on some of the government hiring, you really do need to see the other private sectors begin to pick up that slack. And that's something that we just still haven't seen a lot of. And when you look at even some of the most recent indicators, like the NFIB hiring plans that came out for February yesterday, dropping back, it's hard to see a lot of that offset taking place over the next few months, particularly when you still have relatively tight monetary policy.
Sarah, how much could the Trump freeze on federal hiring that came into place in January impact this report?
Yeah, so I think that's really to the extent that you will see a decline in federal hiring. I think that's really what's at play here for the February numbers. And so, we wouldn't be surprised if you saw the federal hiring line maybe decline by about 5,000, maybe as much as 10,000. So that would mark a departure from that 4,000 trend. But we do have a little bit of guidance here. If you remember back in 2017, we saw a hiring freeze instituted at the start of the first Trump administration, but really that didn't seem to weigh down federal payrolls that much. So even in those first 3 months of that hiring freeze, the federal line only declined by about 13,000. So I think it's at play, but still looking pretty minimal here, especially in the near term.
You're expecting 170K for February. What do you make of these estimates that range from 30K to 300?
Yeah, I think it speaks to just all the uncertainty that we're seeing right now, where I think it's clear that we do have a lot of headwinds mounting with, again, some of the trade policy, some of the federal spending policy. But I think there's also some difficulty around the start of the year when it comes to weather. So we had, again, some severe winter weather in February, but not quite as much of a departure from what we saw in January. And the early part of the year is when we tend to get some of the biggest surprises in the economic data, particularly around payrolls, just because of those big seasonal effects. And so I'm not surprised to see that wide range of estimates this month.
Hey, Sarah, appreciate your time. Sarah House of Wells Fargo, looking ahead to payrolls at 8:30 Eastern Time. This economy could go through a real rebalancing based on that conversation. Just think about what we're hearing. The potential to pull back on immigration, which could affect supply. People have complained about the potential of a supply shortage. That's going to be met potentially with a pullback on hiring in the federal government. So one should meet the other in theory. But then you start to get beneath the surface and thinking about a potential skills mismatch. It's not that simple in practice.
If someone's been working in the government for 20 years, are they going to go work at a hotel and clean rooms. I just am throwing this out there. There's a real question here about what kind of overlap there is. There's also a question of what happens in the process of this transition and how much longer it could take the people.
It's the disturbance, I think, that Trump talks about, not just in the stock market, but the transitions. What Francis said. Scott Bessent yesterday painting this wonderful picture of where they'd like to go, but the destination getting there, it might be challenging.
We could still get there, though, and you've got to keep that in the back of your mind. 8:30 Eastern Time, we'll get there. I hope. Payrolls at 8:30. Coming up, Priya Misra of JP Morgan, Jennifer Flitton of Invesco, Alan Zentner of Morgan Stanley, plus a panel with Amy Wu-Silverman and Laurie Calvasina of RBC. It's been such a long week. Let's get you to the weekend with equities positive on the session so far from New York. This is Bloomberg.
Any adjustment in any economy would be involving some pain, in this case, in the form of a high unemployment rate.
I do think that as the first half of this year progresses, we're going to get some bumpier data in payrolls.
The data hasn't been particularly encouraging of late, and I'd expect that to continue.
Consumers don't see much availability in the job market.
If you start to see more signs that the labor market is weakening, that will give the Fed room to maybe bring that cut forward.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now with equity futures firm up by 1/3%. Two things to watch throughout this morning and into the afternoon. The number one, 8:30 Eastern Time, 90 minutes from now, the payrolls report, and then later this afternoon at 12:30, Chairman Powell speaks. Lisa, going into the weekend.
Which does he emphasize, inflationary pressures or growth pressures at a time where this market is much more focused on growth outlooks, and we're now pricing in 3 rate cuts through the remainder of this year? Does he fortify that view? Chris Waller yesterday, Fed governor, came out and seemed to say, yeah, 2 seems very reasonable. Is that the mainstream, or is that Fed chair governor
running,
Waller?
Maybe,
yeah,
possibly. We heard from a range of Fed officials in the last 24 hours, including Raphael Bostic of the Atlanta Fed, making the point that you might not get clarity on policy for months and months. Later on this afternoon, signing executive orders once again, the President of the United States. As this market and economists across the country and worldwide look for clarity.
They're looking for clarity, and guess what? They might not get it, especially when the president yesterday was giving this reprieve, and he said, you're not going to get another one. And April 2nd, we are going to go with reciprocal tariffs. I'm glad you brought up Raphael Bostic yesterday. He's feeling like many people are. The question is, how does this all sort out? And he says he'd be surprised if we get a lot of clarity before the late spring into summer. Potentially that's by design. What did Francis Donaldson say? You got to have your vegetables first before you get your dessert.
That's the reason why this market is not responding with too much of a pop with this reprieve. You're seeing a 0.4% bounce right now in NASDAQ futures. After a correction since February 19th, it's been down 10% and certainly corrected since the record highs. You're not seeing a massive buy the dip bid because that uncertainty isn't going away, and this doesn't feel like, okay, so now tariffs are off the table. It just sort of means that they're going to be a game that we play for a long time.
Linger. It's an exhausting 6% pullback on the S&P 500. We've said that so many times through the week so far. But it's not catastrophic just yet, and doesn't have to be. Jason Furman, who was an economic advisor to a Democratic president, said that himself. It doesn't have to be the end of the world. And Francis Donald, you mentioned Francis in the last hour or so, said this isn't a policy mix problem. It's a sequencing problem. And that's a really important distinction. Later this year, we'll still be talking about deregulation and tax cuts. Where we are 6 months from now could be a very different place.
It is incredibly difficult as a moment for markets, which are a forward-looking and forward pricing mechanism, to understand how to take a whipsaw in headlines into stride when this economy is a barge. And we've talked about this extensively. It takes a while for things to go into effect. And frankly, when I talk to longer-term investors, they say, we're still going to work. People are still figuring out where they're going to invest. This isn't exactly...
They've got to go to work.
Well, yeah.
Moving to Salt Lake City or to Dallas, apparently.
Is that where you want to go? Which would you prefer?
Salt Lake, Dallas, probably.
Really?
Yeah, Dallas,
the
probably.
Heat?
Yeah, the weather.
Really?
You know,
I guess you don't
the environment.
I mean, well,
yeah.
The environment. Oh, the desert. We can get into this.
Yeah,
later.
we'll get into that later.
Okay.
We're different people, Bramo. That's why this works. Equity futures on the S&P 500. positive by about 0.25%. Payrolls coming later. Coming up this hour, Priya Misra of JP Morgan on an ugly week for markets. Jennifer Flitton of Invesco on tariff whiplash out of Washington. Ellen Zentner of Morgan Stanley ahead of fresh US jobs data joining us a little bit later. We begin this hour with stocks steady as traders await US payrolls at 8:30 Eastern Time. Priya Misra of JP Morgan writing payrolls is critical, especially since the market has started to get nervous about the health of the US economy. Soft data has been weak, but other data has been OK. And maybe this is just payback from a strong 4Q. Priya joins us now for more. Priya, good morning.
Morning.
It's good to see you. Neil Dutta of Renmac talked about this as well. Is the trade story just an ex-post rationalisation for a slowdown that already started? Or is the trade story the real deal and it's starting to bite into the data? Which one is it?
I think it's sort of both. We did come into the new administration with momentum. Now, maybe the slowdown, and we've been talking about the K-shaped recovery. I think we've been in that for a while, meaning some parts of the economy has been struggling. Lower income, small business, other parts have been fine. But now, I would highlight there is the trade, tariff on, tariff off. There's uncertainty. That's what makes me really nervous. The uncertainty shock can make businesses stop hiring, slow down, go on pause. That's a decision that they are making. So I think we're at a critical point where if the momentum is slowing and now you have this uncertainty shock, and I think the big assumption in markets has been that the good stuff will offset all this. Where's the good stuff? I mean, it's taking a while. The sequencing was important. You've been talking about that. You're not getting the good stuff just yet. We're dealing with a shock right now. And I think the market's assumption that this was all negotiation, that there is some pain point. We heard from the president a little discomfort. I'm feeling a little more than just a little discomfort. But if this is the Biden economy, that pain point is actually potentially worse. I think that's why the market's so focused on what was the momentum going into this uncertainty shock.
A little discomfort for the economy is a good thing for the bond market, for treasuries. They rally on that and have rallied coming into this week for 7 consecutive weeks. Yields have settled down. They're a bit steadier so far this week. They're down this morning. We often ask you this question. How do you think the bond market is set up going into the data at 8:30? Are we more sensitive to strong data or weak data?
I think it's still asymmetric, meaning we'll get a bigger reaction on a weak data print. Now, we've had a big move. You're absolutely right. But I think that's the market taking that, that side of the distribution that the economy may be re-accelerating. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk. And here's what I look at. I look at the end point of those rate cuts that the market's pricing in. It's 3.5%. So the terminal rate that the market's pricing in for Fed funds is 3.5%. That you could argue is still restrictive. Now, we can always debate where's our star. 3.5%, it's in that gap. So the market's not pricing in accommodative Fed policy for good reason, because the economy is okay. We have the stagflation risk with tariffs. So if you get a weak number, I think the market's going to say, well, the Fed's going to view the tariffs as a one-time shock, a price level shock. They're going to focus on the uncertainty shock, on growth slowdown. They're going to cut. So you get a weak number. The Fed, I don't think Chair Powell's going to signal more rate cuts. But the market's forward-looking. The market's going to price in a lot more rate cuts. So I think that asymmetry, it's a little less today than it was a week ago, but it's still there.
How does the story get complicated by Europe's fiscal spending plans?
Great point. And if I look tired, it's because this week.
Yeah, that's the reason why I'm sitting here trying to wrap my head around all the different components here that kind of muddy the waters.
Right. So I think that has more implications in our mind on the curve and on the cross-market spread because of everything going on in the U.S. If we didn't have the uncertainty shock, we didn't have this tariff fears, I think U.S. rates would have been higher because this is a historic amount of German supply coming in. That's duration supply would have taken term premiums higher. But now if you're worried about the U.S. economy, I think that's why U.S. rates have been much more focused on domestic issues.
Wait, hold on a second. You're saying that because Europe is going to be borrowing a lot more and supply concerns might be more of an issue there, and because the U.S. economy looks weaker than a lot of people presumed it, that actually money will flow into the United States as more of a haven play? Is that what you're saying?
I think if we're talking about recession risks, yes. U.S. exceptionalism is over in our mind, but this is a decade-long. I mean, look at how much money came into the U.S. So I do think that the exceptionalism story is over, but if we're talking about recession in the U.S., the dollar becomes a safe haven play for the short term. We look at, is that the pain point for the president? Do some of these negative growth policies stop or pause? So I think in a recession scenario, I think we could take a pause from that decade-long view away from the US, or maybe a multi-year view, because these things take a while. Exceptionalism has been such a prevailing theme. I think that's ending. But certainly, I think if the US economy is headed into a recession, so far, it's the only source of strength for the global economy. I think the market's saying, well, that's going to change, and Europe's going to have all this demand and defense spending, infrastructure spending, but that's a longer-term view.
And how do you know whether or not with Europe it's a false start?
That's fair. There's a lot of uncertainty out there. I think the fact that it's Germany, that I think the periphery has been asking, the world has been asking for Germany to spend.
Decades.
They've got low debt to GDP, low public debt to GDP. So I think the fact that it's Germany, the fact that they're moving at very fast speed. I mean, for Europe, this is super accelerated speed in trying to get this done. I think that's why the market's paying attention to it. The numbers are large, and for good reason. I mean, we have the geopolitical risk. You all have been talking about how it's all sort of coming together. So I think the market's taking it seriously. We've had big moves. But I think if we're seeing the numbers that we're talking about, I think there's still a lot of room for those rates and growth.
If you think this is the end of U.S. exceptionalism, but this administration wanted to continue it, what would you want to see?
I think we'd like to see those growth positive policies being put in place quickly.
Sequencing.
Exactly. The sequencing, get the House. So the House bill that did pass has about $2 trillion in spending cuts. To me, that's growth negative, at least in the near term. You have the spending cuts, which typically, economists argue, have a higher multiplier than tax cuts. And let's talk about tax cuts as opposed to just extension. In my view, that extension is not new stimulus. So we need to see where that stimulus is coming from. Where can we get businesses to invest? Maybe this is a reprivatization of the US economy, but then we need businesses, we need the private sector to start to invest, not pull back.
And the transition won't necessarily be smooth. So let's talk about that. What's your reaction to Treasury officials, administration officials talking down this economy and saying it's Biden's still and may not be theirs for another 10 months? What are they setting us up for?
I think they're telling us that there's going to be more pain in the equity market and pain in the US economy potentially in that transition, but it's not the pain point for them to reverse policy. And I'm glad you bring this up, because how should we trade this? Well, this is why I would say people who have bought into risk assets, they've had a great time. Fixed income has had no income or diversification. You're getting both right now. If you're in actively managed fixed income portfolio, look at whether it's Deep Seek Monday, Tariff Tuesday. I guess now we have Tariff Wednesday, Thursday as well. But you have a lot of headline risk. Anytime risk assets struggle, and I don't think we're at the pain point because we're not hearing that from the administration, risk assets are very vulnerable. And that's when bonds make sense.
Can I ask a more direct question? Lisa's alluded to it a few times already over the last week or so. It's a conversation that people are having, and I know it's a conversation you will have heard. Is this deliberate? Are they deliberately engineering a slowdown to get lower bond yields?
I have heard that. I really struggle with that.
I struggle with it too, but it's out there.
Because if you get low bond yields because inflation's coming down, that's good news for all markets. If you're getting low bond yields because we're worried about a recession, that, I think, fuels negative sentiment, and then it becomes this negative cycle. So it's like, I don't know, shooting yourself in the foot to make sure your gun works. Not smart strategy. So I think they're hoping that the market can look ahead at the end point and not have a big drawdown. But, sentiment's a tricky thing. Behavioral finance will tell you people get nervous, they cut back, and then if the layoffs start.
It's hard to correct course.
Exactly. This is not a very dynamic labor market. So I worry that even small layoffs with not a ton of hiring can actually make the labor market look worse, and then it feeds on itself.
More jobs data coming later, 8:30 Eastern Time. Priya Misra there of JP Morgan on the bond market and the economy. The Treasury Secretary Scott Bessent speaking to the American press this morning. Comments earlier suggesting there's going to be a detox period for the American economy. We could be seeing an economy that's starting to roll a bit, an economy that we've inherited.
There is a real question here about the idea of a shallow downturn that lowers bond yields, that weakens the dollar to bring investment to the United States, if you believe that that could be a tool used, and to rejigger some of the trade alliances to then build something else. And so you could argue, and that is one conspiracy theory that's out there, that to your point, this is deliberate, and this is actually something they welcome, and is the reason why they're targeting the 10-year and not the stock market.
Just want to be clear, not my point. Just
not my point either.
We've heard it's out there.
We've been hearing this from people. Come on, it's fair to illuminate something we've been hearing.
The American economy is a super tanker.
Correct.
So difficult to engineer those kind of things and hope for a soft landing.
Well, part of the reason why maybe there's confidence that they can handle it is because the U.S. economy is so strong, which is the reason why people are looking at the lagging data to understand just how strong this economy actually is.
Bond yields are lower this morning. The equity market's firmer. The jobs data comes a little bit later. Let's give you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. China's top diplomat attacked President Trump's approach to China and tariffs at the National People's Congress this week. Foreign Minister Wang Yi said, quote, the U.S. shouldn't return good with evil. The diplomat defended the country's actions on stemming the flow of fentanyl to the U.S. and accused Trump of using the issue to pressure his government. Broadcom shares, a check on those this morning, rallying 11% to the pre-market. The company, which supplies chips to Apple and other big tech companies, gave an upbeat forecast. It does suggest that the AI spending boom is still going strong, Broadcom being a major beneficiary of those expenditures. U.S. officials are searching the world to find eggs to ease the shortage that has sent prices soaring. Poland, France, and Indonesia said that they're fielding inquiries from American embassies and the Department of Agriculture about exporting eggs. 70 to 100 million eggs are needed to be imported within the next month or two in order to fill in the gap left by the bird flu outbreak. That's your Bloomberg brief. John.
Danny, thank you. Another update from Danny in about 30 minutes from now. Up next on the program, Trump taking an eye off stocks.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones. I'm not even looking at the market because long term, the United States will be very strong with what's happening here.
Jennifer Flitton of Invesco joins us next, live from New York City this morning. Good morning. The jobs report 1 hour, 13 minutes away. Your scores look like this going into it. Equity futures right now positive by about 1/4%, up 1/3 on the Nasdaq. Likewise on the Russell. Under surveillance this morning, Trump taking an eye off stocks.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones on relatively small, although it's a lot of money having to do with Mexico and Canada. But the predominant tariffs will go. They'll be reciprocal in nature. I'm not even looking at the market because long term, the United States will be very strong with what's happening here. This is something that we have to do. There'll always be a little short-term interruption. I don't think it's going to be big.
So here's the latest. President Donald Trump saying he's not worried about disruptions to markets as he pushes through the tariff agenda. Trump exempting goods covered by USMCA from duties until next month, when he's expected to announce reciprocal tariffs on April 2nd. Joining us now from the nation's capital, Tyler Kendall at the White House. Tyler, we've heard from officials in this administration that weak data is Biden data, that they've inherited an economy that might be rolling over, that they're not looking at the stock market, there might be some disruptions. Are we learning quite quickly that maybe their threshold for pain is higher than we thought it was?
Right, and John, the big question there is when are they going to start transitioning from what they are calling Biden data to Trump data? And a headline just hitting the terminal in the last few minutes that Scott Bessent, the Treasury Secretary, actually saying that the stock market is part of the information that President Trump takes in every day. We did actually get a preview clip from President Trump earlier this morning in an interview he conducted with Fox Business, where he was asked if the business community should expect any more clarity around his tariff plans. And his response was that the U.S. reserves the right to keep hiking tariffs, and he's not sure there is any predictability around that. This White House has largely brushed off concerns when it comes to uncertainty around its tariff plans that have contributed to this market reaction. We should also note, of course, as you'll recall, earlier this week during his address to a joint session of Congress, he talked about interest rates, but he did not talk about the stock market. And us reporters here have repeatedly heard from White House officials that this uncertainty is really twofold. They're pushing that this has to do with the urgency that President Trump is trying to accomplish this agenda item, but also that it's a negotiating tactic. Not everyone, though, John, of course, agrees disagrees with that assessment, particularly as we start to hear conflicting information from senior administration officials on what feels like almost a daily basis. And of course, the other part of this is also perhaps mixed messaging on when it comes to the potential economic impacts for the economy around these tariff plans. President Trump previewing that there could be an adjustment period, but also then yesterday, Treasury Secretary Scott Bessent saying that it is not the American dream to have access to cheap goods.
Tyler Kendall over in Washington, D.C., outside of the White House this morning. Tyler, thank you. Let's extend the conversation with Jennifer Flitton of Invesco. Jennifer, people just want clarity. I think officials running companies right now, business leaders want clarity, investors want clarity. Officials at the Federal Reserve want to understand when they'll actually get clarity on what tariffs actually look like. Do you see them getting that anytime soon, or do you think this is just going to be a feature of the next 3-4 years?
Yeah, no, I think that's a great question. I think uncertainty that we're experiencing now is likely only to get greater, especially in the immediate term. Look, I mean, this April 2nd deadline, this report on reciprocal tariffs, this is the centerpiece, really. If you look at all of the EOs that came out, the executive orders, this one, this America First EO that calls on these reciprocal tariff report to really take a stock of the entire global trading system and how it affects the United States. This is the report that I think we really should be focused on, because I think this is going to start those negotiations country by country, where you have the Commerce Secretary and the USTR head really working together to begin that process.
Jennifer, you just said something really important. Start those negotiations. So is it your understanding that on April 2nd, we just get the administration outline what they want to go after, not actually the tariffs in place?
Well, that's the question. So are they going to move forward like they have with DOGE, kind of break things and then see where the most painful, the most disruptive areas are and sort of retreat? Or are they going to take this report? Are they going to have a slow and a more steady approach to trade negotiations, bilateral or multilateral? We know that the USMCA is up in 2026, but those negotiations really are clearly starting now, right? Do they move a little quicker? Do they allow for this administration to have the leverage in actual talks to start to make changes towards 2026?
You know, the business community, financial market investors, they're all talking about the fact that this uncertainty they don't like. They want clarity. But if you are a negotiator for the U.S. government sitting across from the Europeans or the Chinese or the Canadians, how much leverage do you have with that uncertainty coming from the President of the United States?
Yeah, no, I think that's a great question. And, you know, what is good for the market, what is good for Wall Street, and what is good for Main Street aren't necessarily always aligned. They're not necessarily mutually exclusive, but you have this president, you've noted it on this show today, talking about the fact that he's not going to be watching the markets, right? Well, maybe he's giving them up for Lent or something. But really going forward, it's going to be those areas of the country where he wants to bring the manufacturing home. It's going to be the heartland. It's going to be the middle part of that country that he's really going to be focused on moving forward.
How much support, Jennifer, do you think that President Trump has in rearranging the way that the U.S. economy functions, even if it is at the cost of a shallow recession or some sort of shallow downturn?
Well, I do think we need to keep in mind that it's not just trade, right? It's going to be further tax reform. We're going to start to see some deregulation as the agency heads take hold, not just, you know, the cabinet officials, but going down, you know, the deputies and the assistant secretaries, the heads of the independent agencies. You saw a little bit of that in Bessent's speech yesterday, deregulating the banking industry. We're going to see a lot happening at the SEC. You know, that can really spur some pro-growth deregulation that can affect the market and businesses going, you know, down the supply chain.
When you talk with Republican congressmen right now, behind closed doors, are they saying, actually, if you do wait and see, this will unleash this investment cycle, this growth cycle that will be very exciting for people, so we're willing to take the anger from our constituents now? Is that the message you're hearing?
Well, I think it really depends on the member of Congress, right? And there's really a small handful in the House of members who are in those toss-up districts and are going to town halls or going to chambers of chambers of commerce meetings or the Kiwanis Club, the Lions Club, right? And hearing tough talk. A lot of these members are fully bought in, not just of the movement on trade and deregulation, but on DOGE as well, and sort of the auditing of the federal government. I think one of the first steps here is going to be how the White House can really control going into reconciliation. And once we get past the CR, funding the government into 2025, we're going to dive into that reconciliation.
Jennifer Flitton of Invesco. Jennifer, got to leave it there. Lots to talk about through the next year, that's for sure. And lots to talk about this morning. 1 hour from now, the payrolls report is just around the corner. Equity futures at the moment shaping up as follows on the S&P 500, just about firmer by 0.2%. Still on course, though, for a big week of losses, the biggest weekly loss of the year so far. Joining us to break it down, Amy Wu-Silverman and Laurie Calvasina of RBC on a wild week for financial markets worldwide. Jobs report is about 60 minutes away. It's just around the corner. Payrolls about an hour from now. Going into that, equity futures at the moment positive by about 0.1% on the S&P. We're up by 0.2 on the Nasdaq. It's been a really choppy week so far. Let's get you some single names, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. I've got some earnings for us to work through. Well, starting with sales, to be specific, from Gap, a turnaround story for the ages for them. Those shares are up 16.5%. Really strong results across all of their brands thanks to their new CEO. Interestingly, their outlook also came in line with estimates, and they say that does incorporate 20% tariffs from China and 25% from Canada and Mexico. Another really strong set of earnings this morning coming from Broadcom, and this is something the chip industry needed after less than spectacular earnings from both Nvidia and Marvell yesterday. Broadcom shares up 10% in the pre-market with a strong set of results. If it sticks to that, it'll be its best day since December of this prior year. They also said that they signed new hyperscaler customers, saying that demand for data centers, it is still there. Finally, that's the good tech story. The bad tech story this morning is HPE. Those shares down a whopping 20%. If it can hold on to those losses, it will be its worst day since 2020. Basically, they said their profitability is under pressure. It, one, comes from tariffs. It, two, comes from some margin compression on their servers and what it called some execution issues. HPE announcing this morning that they will be cutting 3,000 jobs. John.
Hey, Danny, thank you. I think tariffs in some cases can become a convenient excuse for certain companies. This is an unforgiving market. It's not a good time to be saying the kind of things that company is saying.
Especially at a time when the bar is already pretty high, which it has been for HPE. There is this question, though, and I think that this is the right question to ask. How much are companies sandbagging their results going forward and using it as a convenient excuse to lower the bar so that they don't have to, go over and above?
Are you talking about the retailers?
Yeah, in particular.
Target, Home Depot,
Walmart.
Bit of Walmart as well.
Yeah, basically just lowering the bar and reducing some of the pressure that they have to meet the execution.
The problem they've got is that if they put out decent guidance, no one believes it anyway, which is what happened with GM in the last month.
I mean, how do you price a negative infinity? That was what Tom Narayan said, and I love that quote.
With great difficulty. On our radar this morning, let's talk about Bitcoin falling after President Donald Trump signed an executive order creating a strategic Bitcoin reserve and stockpile of other digital assets. The details of the plan falling short of industry expectations. What were they expecting?
They were expecting taxpayer money to be used to buy crypto assets. And instead, it turns out that the United States is one of the biggest crypto asset holders because of seized crypto assets from people who are using them for criminal use. So what they're saying is all those Bitcoin stashes and other crypto stashes that we have from criminals who we've seized, we can now put in a fund and use any proceeds from that to invest further in the crypto industry. And that's highly disappointing to the crypto industry.
One key to this executive order was basically it will impose no incremental cost on American taxpayers. So a lot of people are looking at this and they're like, we like this. We don't want our money going to crypto. But the crypto bros are a little bit annoyed. But today, Donald Trump's going to have a roundtable with all of them. So maybe we'll get some more details.
And we'll hear from the crypto czar. Donald Trump's crypto czar, David Sachs, at 11 a.m. Eastern time. David Sachs is a really smart, intelligent, sharp individual. A question that I'd have for him and I'd love to hear answered. I want to understand why it would be in the America's interest, the issuer of the reserve currency, to even use taxpayers' money to have a strategic Bitcoin reserve. Why does that even make sense?
Well, and they could argue that they're not, right? Because they're not going to use taxpayer money to actually buy Bitcoin or crypto assets. The flip side is, if you seize assets, typically you can liquidate them and then put them in the coffers of the United States. So is it a better use to keep them in crypto than to liquidate them and put them in some other capacity?
Look out for that debate a little bit later. Elsewhere, President Donald Trump temporarily exempting Mexican and Canadian goods covered by the USMCA from his 25% tariffs. Trump signing orders paring back the levies until April 2nd, when he's expected to unveil plans for reciprocal tariffs.
So we just heard from Jennifer Flinton there and how April 2nd is becoming so important. I think what we really need to start to decipher and look at when it comes to April 2nd is based on how to do this legally. When April 2nd comes, not a lot of the tariffs can actually go in place that day. What this is going to be, broad strokes, what we think this administration is going to be going after, and then the tariffs will come into place weeks or months after. And between those weeks and months, there's going to be a lot of hurdles in between. This will be the space that the Trump administration has to negotiate with all their trading partners.
Yesterday, I spent a long time trying to understand what was eligible for the exemption and what wasn't. A White House official said that about 50% of goods from Mexico and 62% from Canada, including computers, will still face the tariffs that are implemented as is at 25%. Really interesting question around whether they need to apply for the USMCA exception, and they just haven't done so yet. But again, this is a moving picture, and it doesn't mean that there's not going to be any kind of pain in the near term.
Because a lot of these companies have products that come under the country of origin order, which means that they've basically been able to go in and out without that extra tax. And now they're all going to rush and be like, we are USMCA compliant, give us the stamp.
We're all debating this. Meanwhile, 20% tariffs on China, just like that. Hardly talked about it for the last month.
If you look at some of the earnings results, a lot of people have talked about how much they've moved away from Chinese production, and we heard that from Gap yesterday as well. That's why they are more immune to those particular tariffs. This has been in the works for a while.
Are you ready to move away from New York? Goldman Sachs giving some of its New York-based employees a chance. A choice to move to Dallas or Salt Lake City, or leave. Sources telling Bloomberg the bank is trying to send more managers to areas outside of its main hubs in a plan informally called Project Voyage.
The name Project Voyage, I think about going on a ship, somewhere exotic, Greece. Yes, Project Voyage, go to Mars and never come back. I mean, there's a question here about the ultimate goal and how many people are trying to do this. I will just say, to your point, Salt Lake City.
Yeah,
I mean, I going
people
skiing.
Feel the same way about Dallas.
I mean, at a certain point, it's kind of great.
John.
Was it Alliance Bernstein years ago that came out and said we're going to have to move people to Nashville?
Correct.
I think it was. And at the time, the New York snobs all came out and said, why would you want to do that? If they did that now, people would be very willing to make that move.
One question I have, are they going to pay them the same? Or are they going to lower the cost of living in order to comply with that region? Is that part of the goal to sort of reduce some of the luster around the move?
We've seen a huge transfer of wealth from, say, New York to places like Florida under the pandemic, and potentially we're going to see more of that. I also wonder if some of this is political. Get out of some of these big blue states and move into maybe some red districts.
I'll take a 10% pay cut to move to Dallas. Does that work? Maybe.
You think you're negotiating right now?
To move the show. Take the studio,
You're negotiating right now?
Sure, why not? In real time.
Rachel.
I'm going to choose Miami.
Let's turn back to stocks. The S&P 500 heading for its worst week of the year after tariff headlines out of Washington whipsawed markets. Amy Wu-Silverman and Laurie Calvasina of the brilliant team over at RBC join us this morning for more. To the two of you, good morning. Massive changes in the last few months. So let's take a giant step back. Amy, and let's start with you. How much has changed for you and the team coming into 2025 compared to where we were in the sleepy years of 2024?
A lot, John. And Laurie knows this. I've been calling this market a paddling duck market because it looked calm and smooth on the surface. All the violent rotations you saw, they were really underneath the surface. And I think at this point, the duck might have fallen off a waterfall or something. It hasn't been good. And, that from a volatility perspective comes down to very high dispersion in the market, very low correlation. These have all been flipped on its head. We see all these metrics climbing. They're not at alarm bell levels yet, but, we're at a psychological 20 threshold of the VIX, and we're starting to think back to the trade war situation from 2016 and 2020. And the questions I'm getting asked now are very different than the questions I got last year. It's much more about how much higher can we go from volatility, how much more downside can we see in S&P versus the other way around.
So, Laurie, if the duck just fell off the waterfall, I am curious about what that means in terms of just how much less desire there is to go into stocks that have implied volatility that's significantly higher. I mean, the volatility in itself really lowers risk-adjusted returns given how much higher that risk is.
No, look, I think from our perspective, right, we thought it was going to be a rocky path to 6,600 this year, and that's still our call. But we're starting to question the rockiness, right, and how rocky are things going to get. And, we look back to kind of November when we were putting our year ahead outlook together, and I said, there are 3 of my models that are sort of on the cusp of misbehaving. And so I felt compelled to write a bear case and said, we're on this good path, but it's possible we could get knocked off. And if we get knocked off, this is what it'll look like. So that number is 57.75. We're not, making the call that we've gotten knocked there, but we do think the risks are rising, right? And we came into the year saying 5 to 10% drawdown. I think, maybe the duck would have been furiously paddling, but still be alive. But at this point,
we haven't killed the duck.
We haven't killed the duck, but at this point, we just keep writing the same thing the last few weeks, which is this risk of something deeper than a 10% drawdown, kind of going into what we call the second tier of fear, like a 14 to 20% drawdown. That is rising, and we're not saying that we have to write the year off right now. I think there's a good chance to stay on that path, but we are at a tricky spot, and I think the next few weeks are frankly pivotal.
Well, this raises this question, Amy, if you're seeing this in the derivatives trades, if people are putting on calls for, say, another 15 to 20% down that you hadn't seen for years.
So far the answer is no, but I really like Lori's second tiers of fear because we actually can quantitatively measure that in derivatives, right? We can say, well, what's the cost of a 1 standard deviation drawdown in the market? You can look at that with SDEX. What's the cost of a 3 standard deviation drawdown in the market? You can look at that with TDEX. When you look at that over 5-10 years, we're actually still floating in the 40th to 50th percentiles. So the second tier of fear, that perhaps that growth scare, whatever you want to call it, that tail isn't being priced in as an actuality, but I think that risk is climbing.
Lori, do you think the president starts to actually pay attention to the markets if it's a 15 to 20% drawdown?
I think it's a question, right? Where is this Trump put? Does it even exist? And when we get to kind of the end of tier 1 of fear, and I do, by the way, scare everybody when I talk about it. I apologize for that. I know this is a terrible thing.
Second tier of fear sounds quite frightening.
Second tier of fear is really
with
not
a dead
that
duck.
But when you get to the bottom of tier 1, right, that's the 10% drawdown. That's when you start to see hints of panic. And so I think that's the first battleground. And it's going to be really interesting to me to see if we do have any adjustments at that point in time. And you've got some important technical levels coming up. But the second tier of fear, right, I mean, these are issues like 2010, 11, 15, 16, 2018. We had an industrial recession, right, in 15, 16. We had the debt downgrade. We had the European debt crisis. These are all big scares where people thought something systemic was going to happen or that we were headed straight for a recession. And we pulled back from the brink, but there was just a tremendous amount of fear then.
I saw you yesterday at the Scott Bessent Economic Club of New York speech. I got the sense that the market is not in line with the administration on where they're going with tariffs. This market thinks everything's a negotiating ploy.
Yeah, look, I think that there's been a continual, confusion, right, about kind of the logic of some of the administration's goals when it comes to tariffs. And I would say particularly from non-U.S. investors, and we are starting to see money go back into Europe. So you can put 2 and 2 together there, right? I do think this is having an impact on the desire to be in the U.S. equity market. But look, I think that, what I took away from that speech yesterday is I thought there was sort of a statement of philosophy. I'm an old high school debater, so when people get up and present their case, I really, I'm appreciative, right? And I was there to listen. And so I understand what they think they're trying to do. I just don't think the street is buying it right now. And, you sort of had that discussion right in the speech where you're sort of talking about tariffs. And, we're also trying to lower 10-year bond yields, and we're trying to get gas prices to be lower and sort of trying to pull people out and look at the big picture. But I just think that investors that I talk to think that tariffs are inflationary, and they think that the prices are going to be passed through because that's what the companies have been saying on one conference transcript and one earnings call transcript after another. And I just don't think you're going to fight that right now.
We spoke to Francis about an hour ago, and Francis made the point that we have a sequencing problem. I think we're all on board with all of that. That later this year we might be talking about something different. You start with trade, you'll finish with taxes. Steve Chevron at Federated said that the second half is going to be much better than the first half for equities. When you look at options pricing, do you see any of that developing at all?
Well, sadly, John, the tenor shrinkage in the options market, because so many people now trade zero-day to expiry options, the timeline has gone from maybe 6 months out being something you could kind of read the tea leaves for to really being much more muddy. So right now, it doesn't indicate that. As we get closer, perhaps it will. I think the biggest key indicator for me is we start getting those second, third standard deviation drawdown tiers of fear or volatility picking up, that left tail getting fatter. that means the alarm bells are starting to ring. And again, we haven't gotten there yet. Maybe we'll get there down the line.
Could you explain the extent of fear that you can identify right now? Because when we look at things like high yield spreads are still pretty tight. Laurie and I were talking earlier this week. We've had a 5 to 6% pullback. Just a 5 to 6% pullback. It feels dramatic. It's not actually dramatic at the index level. How much fear do you see?
Look, that's about the level we see now. But I will tell you, one thing that is problematic is when you've had several years where correlation is very low, dispersion strategies have been very popular, volatility harvesting strategies have been very popular. There is like a buildup. So one thing we've been talking to clients about is this idea that a growth scare or a third standard deviation drawdown in the market can trigger kinds of unwinds of positioning that you saw on August 5th. And so it's not necessarily that one necessitates the other, it's that one precipitates the other. And that is one of my primary concerns.
Laurie, what do you make of the argument that this is by design? That actually this administration wants the stock market to fall, wants there to be some weakness, wants to lower 10-year bond yields to try to rejigger some of what they're trying to do in that theory that Scott Bessent was presenting?
Well, I think they've been pretty clear, right? And you even heard this in the speech yesterday, right? That this is about Main Street, right? Not necessarily about Wall Street. And I think they've been pretty clear in their focus on the 10-year yield. I think what exactly the intentions are regarding the equity market are not quite as clear, right? But I would say, what I took away from the speech yesterday is it's not the highest priority. And look, just to take a step back, I'm an equity strategist. I've been doing this for a long time. It is not our policymakers' job to sit there and prop the equity market up, right? Like whoever is there, you want them to do whatever they think is the right thing to do. Doesn't mean equity investors are going to like it. But I do think, I took away yesterday from the speech that, I wouldn't say this is necessarily equity market specific, right? But the idea that there may be some short-term pain for longer-term goals being achieved or longer-term gains, that was a theme I took away from that presentation. And I think it's an important one to keep in the back of our heads as we're trying to navigate this 6 to 12-month period, which is very much the short term.
They've communicated that a few times. In some ways, it's kind of refreshing compared to what we've had over the past few decades.
If there is a goal that also can be clearly articulated, the big question mark, I think, for a lot of people is, and I think that you're right, it is refreshing and potentially a lot of people agree with the goal. The question is, can you orchestrate short-term contained pain that doesn't take on a life of its own?
A little bit later this morning, 8:30 Eastern Time, we'll get the payrolls report. We'll see if there's any pain in that. Then later we'll hear from the Fed Chair, Jay Powell. Just on behalf of the whole of the team at Bloomberg Surveillance, a special thank you to the amazing team, phenomenal team over at RBC. Thank you, guys. Appreciate it. Amy Silverman there and Laurie Calvasina. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The World Health Organization asked some employees to consider early retirement, trying to cut costs after President Trump withdrew from the agency. Sources tell Bloomberg that staff who are 55 or older by June received an early retirement offer this week, along with 4 months' pay. It's unclear if the WHO will resort to layoffs if not enough staffers take the offer. Bayer shares are tumbling after reports that the pharma company is seeking to raise capital to help resolve its legal troubles in the U.S. Shares down 6.5% pre-market, or in the German trade, rather. It's already spent $10 billion of the $16 billion that it set aside for lawsuits over its Roundup product and has agreed to pay almost $2 billion to settle cases related to toxic chemicals. Texas is expanding its role in next year's FIFA World Cup beyond hosting matches in Houston and Dallas. Dallas will now also be home to the International Broadcast Center and host 2,000 members of the media for the 2026 World Cup. The Texas city will serve as the tournament's media hub and sites of 9 games, more than any other location. Maybe another reason for those Goldman Sachs employees to move to Dallas. And that's your brief, John.
You said it, Danny. It's exactly what I was thinking. Dallas is happening.
Honestly, no, it's not happening.
Starting the negotiations for 26.
Yeah, you started them on air about 10 minutes ago.
Just for the summer.
Really?
Yeah.
Are you kidding? Have you ever been in Dallas for the summer?
Yeah.
What? Seriously?
I've transited through Dallas in the summer.
Do you like heat therapy?
Love the aircon.
Okay.
Fantastic aircon in Texas.
This is over.
I didn't have works for the summer.
No, we got to go for the winter.
This is over.
We're going for the World Cup.
Let's move on.
Oh, yeah. I would be down with that then.
Thank you. All right, you're on board now.
And they're adding more games.
Terrible treatment for the workers.
Up next on the program, Team Transitory.
While I've agreed not to talk about prospective Fed policy going forward, I would hope that the failed Team Transitory could get back together and think that nothing is more transitory than tariffs if it's a one-time price adjustment.
Getting the band back together. Up next, Ellen Zentner of Morgan Stanley. The payrolls report is about 40 minutes away. Look out for that. More economic data coming up. And the surveillance this morning, team transitory.
I would think over the coming months, we're going to have a couple of adjustments. Can tariffs be a one-time price adjustment? Yes. While I've agreed not to talk about prospective Fed policy going forward, I would hope that the failed team transitory could get back together and think that nothing is more transitory than tariffs if it's a one-time price adjustment.
The Treasury Secretary Scott Bessent taking game with the Federal Reserve while defending President Trump's tariff agenda. A little bit later on this afternoon, Fed Chair Jay Powell speaks at 12:30 p.m. That follows the payrolls report later this morning. Ellen Zentner of Morgan Stanley joins us now for more. Ellen, good morning. It's good to see you.
Good
Let's
to see you
start
guys.
there. Team transitory. How transitory are tariffs with regards to inflation?
It depends on if there's spillover effects from that. So, a lot of people, including myself, go back to the washing machine example from 2018, tariffs on washing machines. That should be a one-off level shift in prices, except retailers took advantage of raising the price as well on dryers because it's unlikely you're going to go in for a new washing machine and not get a new dryer as well, even though the tariff was not on dryers. So there can be spillovers. And the problem with tariffs is that they fall here, there, and everywhere. And you don't know exactly where along the production process that the share of price is going to fall. We know that Chinese manufacturers absorbed a good deal more of it in 2018, 2019 than we thought. But you still had parts that showed up all the way through the production process to intermediate goods and final goods for consumers. It will happen this time as well. We know that. If anyone tells you consumers will not pay at least some of the price, they're pulling the wool over your eyes, right? So consumers will pay. Does that mean you don't do tariffs? Not necessarily. Does it mean that the Fed is going to have to raise rates right away as soon as tariffs go on? That's not necessary either.
There is a larger question, though, about whether consumers are going to push back and not buy as much of certain products if they do have higher prices, and whether that ends up leaving companies looking for efficiencies, i.e. job cuts to save cost, and that you could see it come into the labor market. Is that a ridiculous extrapolation?
No, it's not at all. It's perfectly plausible. I do not think that households have unlimited price tolerance. Wealthy households do, but they're spending more on services than goods. There are some goods that lower income households will have to buy, and that's why tariffs are going to hit them disproportionately. But you will see a hit to aggregate demand for it because we will substitute away for other cheaper goods or just pull back on buying altogether. So companies do have a couple of choices. If they can't raise prices, so that's one choice, then they would look for concessions from their suppliers, and they'll probably get some concessions. And then the other is controlling costs in other ways, which of course falls on labor.
How important is today's labor market report that we get in about 40 minutes' time? Is it really going to give us a sense of the path ahead, or is this really going to be mostly backward-looking to assess the momentum heading into this period?
So I think a lot of folks will treat it as backward-looking because we know the federal layoffs are not going to show up until the next month's report. I was in D.C. earlier this week at the National Association for Business Economics Conference. What a somber mood. The data agencies, it has been chaotic, with no warning of departures. A good deal of the probationary workers are your survey takers, so there was a lot of concern over integrity of the data going forward, funding for those agencies, being completely surprised at how many took the fork buyout, and then just being faced with layoffs. So I just have to work that in there because it did not feel good. But of course, federal employees are in the crosshairs, and DC is heavy with them. So of course it's not going to feel good in DC. But those workers are not going to show up in the numbers until the March data. The headline is going to get knocked around from, do we get some positive payback from the wildfires and weather depressing last month's payrolls? That could just show up in upward revisions, and then it takes some of the excitement out of a big payroll number. But I'm going to be watching flows as well. I mean, we haven't been talking about immigration that much.
True.
Right? 150,000 on average we were adding to labor supply in 2023 and 2024. That swung to probably about minus 40,000.
Huge changes. And Lisa, this could get really messy in the months to come.
And messy because the unemployment rate could actually move lower regardless of what the headline number is.
Ellen Zender of Morgan Stanley. Ellen, appreciate your time, as always. Up next on the programme, Nadia Lovell of UBS, Becky Frankiewicz of Manpower Group, Stephanie Roth of Wolfe Research, Kathy Jones of Charles Schwab.
If you look at the labor market, it's been on that cooling trend for the past 2 years.
I don't know the degree to which the market is going to weigh job losses in the federal level.
I don't see the unemployment rate rising.
It may be all told that the negative hit to employment is slower to unfold.
We have an economy that is fully employed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. It's the big hour. Equity futures at the moment positive by 0.1% on the S&P. Later on this morning, 8:30 Eastern Time, some important economic data, jobs data just around the corner. Later on, you'll hear from two very important individuals, arguably the two most important individuals for financial markets on the planet. You'll hear from Chairman Powell at 12:30 and then the President of the United States later on this afternoon at 2:40 when the President signed some executive orders. But right in front of us, 29 minutes away is a payrolls report, and the estimate in our survey is 160K. The question we've got, will any weakness start to show up in this report?
And right now, the expectation is that weakness will show up. You're looking at a whisper number around 125,000 at a time where the consensus is 160,000. How much is this market biased? And you asked us to Priya Misra, and I thought it was the right question. How much is this market biased to negative news, weaker data, and will respond asymmetrically, more significantly to that kind of downside surprise than an upside one?
And the big question is how much of policy uncertainty might impact this report? The DOGE effects or the hiring freezes that happened at the start of the year with the Trump administration. I want to know when the president speaks, depending on this number, is it going to be Biden data or is it going to be my policies that he's happy with, depending on the number of this jobs report?
A lot of these officials have made the same point, that weak data that we've seen so far, ISM manufacturing, consumer confidence, is so-called Biden data. This is not Trump data in their mind. They also seem to be preparing us for a weaker economy. We heard from Secretary Bessent on the wires earlier this morning say there's going to be a detox period for the economy. They're talking about making this transition from a government-fueled U.S. economy to the private sector picking up the slack. That's going to take time. How much pain they're willing to see in the meantime, I think, is the big question here in markets we've got to answer.
Yeah, or what does detox mean, right? Does this mean that essentially the equity market could just fall just a bit? Or is this that we could actually see layoffs pick up and there could be a significant weakness? Is this something where they want to allow themselves a 6 to 12-month period to move fast and furious, whatever may come, and then all of a sudden offer these other policies? I just wonder, when you start getting layoffs, that takes on a life of its own, and that is really a key question for a lot of people.
We'll see how high that threshold for pain actually is, but in the meantime, two important headlines, I think, over the past few days from the president. We're going to see some disruption from trade. For the market, what market? For stocks? Not even looking at stocks.
I think it's important to note that the president right now continues to say, and we heard this from the Treasury Secretary yesterday at the Economic Club, there will be this adjustment period, this disruption period. It might not be smooth, but we still think the pain is worth it to get to the final destination.
Equity futures at the moment positive just about by almost 0.1%. Coming up this hour, Nadia Lovell of UBS as stocks look to bounce back from a tariff-fueled sell-off. Stephanie Roth of Wolfe Research on why she says it's downhill from here. And Mohammed El-Erian of Queen's College, Cambridge, reacting to payrolls. We begin this hour with stocks on course for their worst week in 6 months on heightened tariff uncertainty. Nadia Lovell of UBS writing, the risk of prolonged trade tensions has increased and the equity market is likely to struggle until there's clarity. We reiterate our near-term view of capital preservation strategies. Nadia joins us now for more. Nadia, good morning. It's good to see you. Let's talk about this. When will we get clarity? When do you expect to get any clarity on some of these issues?
Well, I mean, we're being told April 2nd is the date to watch. At least we'll get some sort of plan at what these tariffs could look like. Now, April 3rd, some of these might be rolled back. We are not certain about what the duration of some of these tariffs will be, the ultimate scope and the magnitude of it. But hopefully in the next several weeks, we'll get some clarity about the direction of travel. But where we end up still remains to be seen.
Frances Donald said this morning from RBC, she made the point that we don't have a policy mix problem. The policy mix could still be favourable. She alluded to that. She said we've got a sequencing problem. that we're focusing on trade now, might have to wait to focus on tax. Is that how you see things?
Not necessarily, because as our core view is that you're not going to get any new tax cuts, an extension, right? But not anything new. The numbers don't add up. What the campaign promises with the pay force just don't make sense right now. And so those numbers will be hard to reconcile. So ultimately, we don't think that you're going to get a boost to the economy from that. Now, right now, in terms of the tariff talk, if that were to come later, would it be as disruptive as it is now? Probably so, because the president is putting a lot of numbers out there, from 25 to 60 to, to 10%, and the duration keeps changing.
And also, on April 2nd is really the start of a negotiation, potentially not the tariffs actually in place. So what do you do in the weeks or months of the negotiation period when you actually might not know what tariffs actually stick?
I think that's what you're seeing in some of the soft data, is that companies are somewhat paralyzed and having a difficulty in planning their schedule for the rest of the year and what to do about capital budgets. And so, we've seen it already this week, the whiplash that you're seeing in the autos. One day tariffs is off, the next day tariffs is off. So that's what makes the outlook a little bit more difficult to get a handle on. It's hard to have any sort of strong conviction right now in the markets, because you do need that clarity to be able to plan and sort of be able to forecast earnings estimates by the end of the year. And until we get more information around that, I think we're sort of still in this wait and see mode. And that's probably where the market is going to be trading in this range and being somewhat volatile.
Every single guest who's come on the show this morning, before the cameras rolled, said, I'm exhausted this week. And I think there is this feeling of just exhaustion trying to process all of the different headlines. And I wonder at what point people say, why should I bother? Why should I borrow with headline roulette? Why should I bother with the volatility? For now, park it in Europe, where there seems to be some momentum and there seems to be some sort of positive news coming out with growth that was better than expected this morning and the potential for fiscal spending.
You can't just do that and park it all in Europe. Like, we are seeing, what I'm hearing from our trade-in desk is that you are seeing flows into Europe. We're all seeing it. I mean, a lot of it right now is really from foreign global fund managers who had been underweight Europe and is sort of trying to right-size that. But remember, tariffs are also likely to be placed on Europe. And so what does that mean for the European economy? Right now, don't get me wrong, we are positive on markets like Germany, and we're quite selective in Europe because we do think that the pickup in spending around defense, some of the reforms that could happen in Germany will be a positive. But you can't put all your eggs in one basket. This goes back to the whole diversification story, if you will.
13 minutes to go before we get that payrolls report, and there's a real question here. No, 23 minutes, excuse me. John was looking at me like, you're doing it wrong. It's Friday. It's been a long week. I'm exhausted, too.
Leave the counting to me.
Yeah. Okay, sorry. 22 seconds and 22 minutes and 30 seconds. It has been a long week. Nadia, I am curious about how much that's going to color your perception of what to expect going forward, given the fact that we could potentially see either a loss of momentum that's more significant from even heading into this, call it Biden or Trump data or whatever you want, or potentially the opposite.
Yeah, we've had conversations before, bad data versus good data. I think that we're in this environment where bad data is bad data and good data might be good data. We're not 100% sure. And the reason being is that if we do get a strong payroll numbers, that can alleviate some concerns in the market, at least for now. But it doesn't answer the questions on what tariffs will be and also what the implications of those would be on economic growth later on this year. And so that uncertainty is going to still hang over the market. You're seeing already in the sort of defensive position in the market and the outperformance of those defensive sectors. So I think that, but a bad number will confirm some of the survey data we already see. And so that soft data becomes hard data. And yes, it's still a question of who data it will be.
I remember when defensive stocks were growth stocks, when it was big tech in America. I just wonder how much of this is about the economic data. How relevant is it to the performance of the NASDAQ that we've seen over the past month?
I would say some of it is the concerns around economic data. You're seeing the outperformance of, consumer staples. You're even seeing outperformance of healthcare, although we do think that there's some fundamentals. When it comes to NASDAQ and tech, obviously that has to do more with DeepSeek. Also, there's a tariff concern, and there's also stricter regulations around chips. We know that the AI diffusion rule cap can go into effect in May. That was passed, issued under Biden. And so that has implication on what it means in terms of the ability to export American technology and Americans' place in the world, and the opportunity potentially opening a window for China to catch up, which obviously has been doing more with less.
So people are talking about broadening their allocation ex-US. I know you're in that camp too, looking at Germany, looking at China. Can we just finish on China? Are you allocating to China with the idea that this might be at America's expense? Can you see a situation where Chinese tech and American tech performs in line well? Or does one perform at the expense of the other?
I don't think one has to perform at the expense of. Right now, China tech is catching up because people had left it for dead, thinking that they couldn't innovate with the restrictions. And DeepSeek, Baba, and others are showing that's not to be the case. I think in terms of American tech, at the end of the day, American tech, there's still a need for compute power. And I think what's going to be important is the continued spending by the hyperscalers in America, but also not so much export controls on chips and American innovation to our allies like those in Europe. I think if you do see that, then that becomes a situation and sort of dampen American growth within tech. But we do think that both can perform well. Right now, you're seeing a bit of a rotation, but look at some of the results that we've gotten this week, the continued demand for compute power. And we even heard NVIDIA said last week, 10 to 100 times more that's needed as we move from training to inferencing.
Can you learn something, though, from how the market has responded to that? That's a stunning headline. Stock's doing terribly. What does that tell you?
Is that concern about the AI diffusion rules that are going to go into play in May? And also, I think there is a question of how much compute powers will you really need? Only time will tell, right? If we continue to see these low-cost models come out. But reality is that these low-cost models are being trained off of frontier models, which need those chips to be able to build that, right? And so we think that the frontier models are still going to have that demand for compute power. And also, at the end of the day, when you start to use AI, and we all show up here as Avatar, that's going to require...
That's a scary future.
I think it's lovely.
I'm not interested in that at all.
I don't know. I mean, Lisa is positive today, so I'm questioning if it's really Lisa.
All right.
I find that unsettling. I've never seen someone so defensive about being accused of being happy.
I think it's important to present the counterbalance to everybody's gloom and doom, the second tier of fear. We need to start having a little bit of a realistic conversation about how much we're on the third tier of fear, the second tier of fear, maybe. Okay, let's just move on.
Never accuse Lisa of being happy.
My avatar will calculate numbers much and better you'll be in Salt Lake City skiing. Your avatar will be on Bloomberg surveillance.
Nadia, thank you. Appreciate it. It's good to see you. Nadia Lovell there of UBS. We are 18 minutes away from the payrolls report. I think I've got that right. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is delaying some Mexican and Canadian goods covered by the North American trade agreement from his 25% tariffs. That includes items like autos and certain fertilizers. The duties are now expected to take effect on April 2nd, when Trump is also set to unveil reciprocal tariffs. Elsewhere, Trump says that he'll probably extend the deadline for TikTok's sale if a deal isn't reached by April 5th. Trump had originally offered ByteDance a 75-day reprieve from a January 19th deadline to sell its U.S. business. However, it's not clear if the president could legally offer a significant additional extension without a deal. A check on Broadcom shares, those rallying up nearly 10% in the pre-market. The company, which supplies chips to Apple and other big tech companies, gave an upbeat forecast. It suggests that the AI spending boom is still going strong, Broadcom being a major beneficiary of those expenditures. And that's your brief, John.
Hey, Danny, thank you. More from Danny a little bit later this morning. Up next on the programme, the Morning Calls Plus, Becky Frankowitz of Manpower Group as we count you down to February payrolls. That is just around the corner, 8:30 Eastern Time. And our survey, the estimate in our survey, the median, 160K. The number drops a little bit later this morning. From New York, this is Bloomberg. Andrew Honhorst of Citi just publishing, could this be the last solid jobs report? Goes on to say, subdued hiring and upcoming government layoffs mean labour market data will likely weaken in the coming months. something that him and the team have been looking for quite a while. At the moment, it's holding up based on what we've seen on jobless claims. If you take a look at payrolls this morning, that number drops in 14 minutes' time. We're looking for 160 in our survey. The median estimate is 160, 8:30 Eastern time. You'll get the result. Equity futures going into that just about negative now, turning lower. We're down by not even 0.1%. We're lower by 0.06%. Let's get you some morning calls. First up, Baird raising its price target on Costco to $11.25, saying it's well positioned to capture additional market share. The stock is still lower by 2%. Your second call from Barclays raising its price target on Gap to 33, citing its fiscal 2025 guidance as, quote, conservative and beatable. That's something Lisa's talked about repeatedly on the retailer side. That stock is up by 16%. And finally, KeyBank raising its price target on Broadcom to $275. The firm optimistic about its leading position as an AI chip provider. That stock is flying this morning. That's some welcome relief for the chip sector. That stock is up by close to 9% in the pre-market. As we count you down to the February payrolls report due out just moments from now, Becky Frankowitz of the Manpower Group writing the labour market is poised for the big thaw after the winter of uncertainty. Yet right now, it is more like the great wait. Becky joins us now for more. Becky, welcome to the programme. Love getting into this with you. Walk us through what you see in the business at the moment, how things have developed versus what you expected a month or so ago.
Yeah, so we entered 2025 with a tremendous amount of optimism from American business leaders, specifically almost anticipating willing economic growth. A few short weeks later, that optimism is now turned to caution. Yet one thing, Jonathan, has remained. The U.S. labor market has been fairly resilient. I know we are absolutely seeing cooling, but it's important to focus on the data versus the dialogue in terms of where is there cooling and where are we seeing still pockets of growth. And that's what we're studying.
Are we seeing pockets of growth in areas that could absorb some of these federal workers that are being laid off?
Yes, the federal workforce makes up about 2% of all jobs in the country. And the percentage that are going to be laid off, of course, it's going to be impactful, but it's quite distributed. So we are hoping that some of those workers come back into the economy in other roles. The places where we're seeing strength in the economy are actually a little surprising. Project managers. So Lisa, when you see project managers start to increase, and I'm talking double digits from January to February on job demand, that means that companies are starting to unleash a little bit of investment in transformation and innovation. So could be an early indicator of things starting to thaw. Other places we're seeing growth, science, R&D, anything around getting your data ready for AI. You know, agentic AI is the hot topic right now in the marketplace. So anything that gets your data clean. And then, not to be left out, truck drivers, demand up 50%, 50 from January to February. So some real strong pockets of growth in addition to the cost-conscious American consumer is still alive and well. Top hirers, Domino's, Walgreens, Walmart, Amazon, a new entrant, Panda Group into Panda Express, if you're a fan, starting to hire in the country. So we are still seeing some pockets of growth. Of course, there are some areas of softening as well.
When it comes to softening, what's behind that? Is it just the policy uncertainty that we hear a lot of corporate executives talk about when it comes to things like tariffs and they're unsure on the direction of travel?
Yeah, I think absolutely, Annmarie. We're seeing this great wait, as I called it. So it's on two-party side. On the employer side, they're waiting to see the impact of tariffs. They're waiting to see what happens to the economy. Again, project managers could be a glimmer of hope. But overall, we're seeing a great wait for employers in hiring. We're seeing a great wait from employees in terms of not quitting their jobs. The quit rates continue to be very, very stable, actually starting to decline. So people are uncertain of whether they can change jobs. And so if you see people not moving and people not hiring, it's quite stagnant in terms of the labor force. And so people aren't taking these big steps out in terms of confidence on either side of the equation. And that's showing up in some surprising places. Government spending, of course, we expect that hiring to tighten. But healthcare, Annmarie, healthcare was down 30% in terms of registered nurses from January to February. Still the largest demand in terms of a job in the country, but down 30%. So that's a bit surprising. Software developers down 10%. These big categories that we've seen month over month growth are starting to tighten.
You're talking about almost an equilibrium when it comes to hiring and firing. But who do you think, if you had to pick, has the leverage right now, the employer or the employee?
Yeah, so I think mentally, it's a great question. The data would say the employer has the leverage. In the mental state of our country, the employee still believes they have the leverage, and perception is reality in terms of tight labor market. I will also say that anyone with in-demand skills, anything around data, anything around the science area, I heard your prior guest talk about compute power, anything in that area, very high demand. Interestingly, we saw a new entrant into the top 25 employers called Outlier Inc. Outlier Inc. They are an AI platform that bring workers from the gig economy into companies. We've never even seen them before, and they showed up.
Becky, we're about a little over 8 minutes. I got that right. 8 minutes from the non-farm payrolls report. And there's going to be a big debate about whose data this is. Is it Biden data? Is it Trump data? When does it become Trump data? How long is the lag usually for the labor market, for policies to be felt throughout? How quickly does it move at a time where it really is something of a barge?
Yeah, and I think you said it best. It's a barge. The jobs report is a look in the rearview mirror, as we've talked about before. We're not going to see the big impact yet in the February numbers. Anticipating we'll start to continue to see some of that softening pull through in March. But it doesn't matter whose data it is. Honestly, it's the American public that we need to be focusing on. And we are starting to see softening in some big areas. It's not a freeze. It's not a full-on freeze, but some softening. And that will slowly start to take effect. I don't see it dropping off a cliff.
Becky, can we ask you how difficult it is to get a new job if you've just lost your old job? We looked at claims earlier this week, just yesterday morning. Jobless claims was OK, no drama there, but continuing claims remains quite elevated. There's a theory at the moment that if you do lose your job, you'll be staying out of work for a while. It's getting harder and harder to find that new position. Is that what you see too?
Yeah, so let me bring some data into that. We actually have seen the number of days it takes to get a job, a lot of volatility in that number. As we exited the year, November-ish, we were seeing about 45 days. Now we're starting to see that tick up again. And so back to the equilibrium question, again, the reality is the data would say the power is with the employer, but employees still feel that power. And so where they're losing a job, they're going out with confidence, and it's taking them, 10 to 15 more days to get a job than it did just a few short months ago.
Becky, appreciate your time. You're one of the best at breaking it down and bringing data for us. Becky Frankowitz there of the Manpower Group and what they're seeing right now in the jobs market. Lisa, that's an important question. The trends at the moment, based on what we heard there, a few of them are a little bit concerning.
If it does take longer to get a job, think about what happens in that gap. If you don't have a reliable source of income, you're not going to spend as much. The uncertainty of whether you're going to get a job will reduce maybe some of the pressure that you're going to put on certain accommodations, or maybe you'll move to Salt Lake City or Dallas. There's just a real question here about the longer term implications, about short term disruptions that a lot of people are talking about.
If you don't have a job, you're not going to go out and maybe spend as much. And we know this is an economy driven by American consumer hedonism. And at the same time, are you going to go out and spend more if potentially, even if it's transitory, prices are higher because of tariffs?
These are little things, just subtle adjustments. We talked about federal workers. If you were a federal worker right now and you had job anxiety and you didn't know what the next few months were going to have in store for you, you'd pause as well. The great wait is what Becky was talking about, and I think that's going to grip a lot of people over the next few months.
So I don't want to go all psychology, but there is a psychology to this question of the labor market.
Of course.
And the idea of the fear of losing a job, the idea of being out of work, of the trauma of being laid off, some of that can have longer lasting effects because people are not just, little pongs in a system. They are humans. And so that can be seen in the economic data, and it's something that's worth discussing.
The president talked about some short-term disruption. We'll see if we get any disruption in this data point later this morning. The jobs report is about 5 minutes away. Going into it, we've seen some major swings in financial markets. We've had a pullback on the S&P 500 through the week of almost 3.5 to 4 percentage points, on course for the worst week of the year. The worst week, in fact, going back to September of 2024. Elsewhere, though, we've seen great appetite for equities, particularly in Europe, in China. Europe's had a stunning week, a massive move in the German bond market, yields up there on a 10-year maturity by more than 40 basis points. And in the FX market, we have seen the biggest weekly gain for the euro in years, going all the way back to 2009. This morning, euro-dollar positive by 0.6%, 108.55. The dollar's been a whole lot weaker. Will the data that drops in a few minutes' time support the US dollar? The jobs report just moments away. The median estimate in our survey is 160K. Joining us to break it down, the February payrolls report with Stephanie Roth of Wolfe Research, Kathy Jones at Charles Schwab, Mohammed El-Erian joining us too, and Mike McKee with the numbers from New York. This is Bloomberg. The payrolls report is just 20 seconds away. Going into it, equity futures look like this on the S&P 500. We are positive, but only just by 0.02%. On the Nasdaq, up by 1/10. On the Russell, up by 2. In the bond market, your scores look like this. On a 2-year, 10-year and 30-year maturity, yields are lower by 3 or 4 basis points. The number we're looking for, 160 in our survey with the print. Here's Mike McKee. Good morning, Mike.
Good morning, John. Well, this is a pretty much in-line number. Doesn't look like it's too exciting, at least from the headlines. 151,000 jobs created. That is just slightly shy of the 160 that was anticipated. The change in payrolls in January revised down to 125 from 143. Unemployment, though, ticks up to 4.1%. We'll look for some detail on that. Private payrolls, 140,000. That's up from 111,000 last month. Manufacturing, 10,000. That's a significant gain over what we had seen, 3,000. Average hourly earnings up 0.3 on the month, down from last month, but matching the estimate. It is a 4% gain on a year-over-year basis. Average weekly hours, 34.1. That is the same as last month. There had been thought that maybe companies were cutting back on production, and that was supposed to reverse, but it did not. Labor force participation rate, though, down as well, 62.4%. Some question about whether that would be happening because of the number of people who are who are not crossing the border right now and getting jobs. So I will look deeper into the numbers, John. Let's see what the markets are doing.
First look, Mike, thank you, sir. Of course, we often say on this program, we see it every single month. The first move isn't necessarily the right move, and we'll see if this sticks. But I can give the early interpretation of things. In this report, there is no big news, and that is the news. There is no big bad news here. So equities pick up on the S&P 500. We're higher by 0.6%. On the Nasdaq, we're up by 0.8%. The Russell recovers by 1.4%. You'll see a similar story emerging in the bond market as well. Yields were lower across the curve going into the number. Coming out of it, we erased that move. Yields now marginally higher across the curve. At the front end of the curve by a single basis point, 397. On 10s, 428. And with that, the euro looks a little something like this. If we can check out the FX market, euro-dollar coming back just a touch at 108.44. So the headline number for payrolls in America comes in at 151. The estimate was 160. No big shockers on wage growth. Unemployment coming in at 4.1% versus the estimate of 4. But I'll repeat the early interpretation, Lisa. The news here is there is no news.
Yeah, the idea that the drama that we've been hearing in the headlines all week is absent from the pure economic data that comes out, and it's just line by line. It's fine. It's weakening, not weak. And you can go to that question. The weakening, though, there are some aspects that people will hone in on, and I want to see more details on. It is the underemployment rate. It is the labor force participation rate, which declined. It is the hours worked, which did stay in line, but it was expected to creep up. These are all signs of companies maybe pulling back just a touch and a little more slack being built into the labor market.
Mike McKee, just to bring you back in, these are subtle shifts to Lisa's point. No big surprises on the headline numbers, but just a subtle mood shift that you're starting to identify in the underlying information. It's something that Andrew Honhorst of Citi picked up on as well going into the number. He flagged this could be the last solid jobs report, that we could see some weakness in the months to come. Mike, is that how you interpret some of this data?
Oh, absolutely. We're going to see the weakness reflected in government payrolls going forward. This time we saw governments up 11,000, but all of that pretty much in state and local governments. Federal down by 6,700. State governments were also basically unchanged. It was local government spending. And Anna Wong of Bloomberg Economics has pointed out some of that was financed by stimulus money that has now run out. Those programs have ended extended. So in those areas, we might see some retrenchment. One of the other numbers that we have to be careful with here is there's a decline in retail employment during the month of 15,000, but about 10,000 of those were workers who were on strike against a grocery chain in Colorado. That strike is over. They'll be added back in next month. So some cross currents overall here.
Real quick, Mike, I am also looking at the revisions, and they are lower pretty much across the board. The prior month came in initially at 143,000. Right now, it was revised downward to 125,000. Private payrolls also revised lower. Is there a tell to the direction that we have seen in the cumulative data about downward revisions to sort of make us think that maybe there isn't the same upward revision trend that we saw a couple of years ago?
Well, you could make that argument, and particularly looking at average hours, that maybe the economy is slowing, and therefore we're not getting as many people, giving as many people as many hours as they had requested. Now, the other aspect of that is bad weather in February, and it may be that people who couldn't get to work, people who are restaurant workers and service industry workers, they work fewer hours, and so it shows up that way. That may also reflect a little bit of what's going on with the lower average hourly earnings than expected. But I think the point is, and John was sort of alluding to this, is that at this point what we're looking at is an economy that hasn't changed all that much. And you can find reasons why it's a touch lower, maybe weather, but you don't really have a whole lot to go on here that tells you which way the economy is going to go from here.
Mike McKee, thank you, sir. Appreciate the update. Breaking down the jobs report. We can continue the conversation now around the table with Stephanie Roth of Wolfe Research, Kathy Jones of Charles Schwab. To the two of you, welcome to the programme. Stephanie, just first to you to talk about the economy. First look, first take.
Yeah, not expected. And as you alluded, the headlines are very different from what we saw in the data. Big reason is just a timing mismatch, right? The survey week fell just before all of the significant layoffs hit. The next payrolls print is going to look a lot uglier than this one. So yes, we can't really have a sigh of relief as a result of today's data, because we're going to start getting hit pretty significantly on the payrolls prints. We're going to start looking at payrolls prints that are around 100,000, if not slightly below.
Kathy, is that how you see things?
Yeah, I think the slowdown is taking place, and we will see more of it. It'll snowball as things go forward. You know, one of the things, when you have fewer hours worked, you have less aggregate income, and that means less spending power for the consumer, so that's going to ripple through. And then you have this level of uncertainty where every day is a new policy. And if you're trying to plan business activity going forward, forget the consumer. Do I have a job or not? But think about businesses. What's my labor force look like? What do my materials cost? Can I get my hands on those materials? What's the demand going to look like? I mean, all of those are big questions that make people freeze and say, I'm just not doing anything till I have some clarity.
Which is the reason why, and Stephanie, a number of people have raised this point. People are trying to understand the momentum heading into this period, to understand the resilience, the potential resilience for the U.S. economy to deal with that kind of uncertainty. 151,000 isn't bad. It actually is a pretty solid labor market. So how much give do we really have in this labor market?
Yeah, and it's fair, but now all of a sudden we had a sudden surprise to activity, and I don't think folks were expecting the extent of the government layoffs that are going to play out, the contractors that are tied to them. And then, by the way, the immigration stuff, he cut off on January 20th, that was adding, for much of last year, about 75,000 workers to the workforce. That's cut off, and their visas are going to start expiring throughout the course of the next 2 years.
But do you think the end destination is still possible? Because what they're talking about is moving from a public policy to more private sector jobs.
Yeah, and that's totally fair, but it's just going to take a while, and it's a painful process along the way. So the end game might ultimately result in a sort of a rebalanced economy, but that doesn't mean it's going to feel good for the next 6 months.
Kathy, this sounds very bullish for bonds, is it?
Yeah, you know, we're still in the camp that says the Fed's on hold for a while because they have to sort out all these cross currents and the inflation potential coming from tariffs, so they can't do anything. So we're in the long end. You have probably the slowdown, which will bring yields back down, probably 10-year around 380 or so, but not until we actually see that data, because offsetting is you have potential inflation from tariffs. So right now we're just bouncing around in this range, waiting to see which plays out first. The inflation plays out first or the slowdown plays out first. Right now it looks like the slowdown might play out before the inflation, but we don't know day to day what tariffs look like.
If you are just joining us, welcome to the programme. The jobs report came out just moments ago, 9 minutes ago, and it came in like this. 151, just a small downside surprise. We were looking for 160. Lots of numbers to talk about elsewhere. To do that right now, we can bring Mohammed El-Erian of Queen's College, Cambridge, into the programme. Mohammed, welcome to the programme, sir. Let's get to that jobs report. What's your interpretation of things?
I think you captured it well when you said, no big news here. The only thing that I would be torturing is the labor force participation, but everything else came in as expected. And I think everybody's right in saying what's more important, what's ahead of us, not this report.
That said, Mohammed, we've been talking a lot about the momentum in the U.S. economy and the fact that it takes a long time to turn things around. Is there any part of this report that makes you concerned about the level of exceptionalism that we're coming off of into this period of uncertainty?
Not in this report, Lisa, but in a lot of other data there is. The edge of the U.S. has been predictability, has been transparency, and you're starting to see more and more business step back, not just on a short-term basis, but really think, how much longer do I need before I figure out what's my operating environment? And that builds on itself really quickly. So, the risk here is that below the economic exceptionalism, which is strong economic performance, strong asset price performance, has been this notion of the U.S. edge. And I worry that this edge is being eroded right now.
So, Mohammed, are you saying it's the death of U.S. exceptionalism?
I'm not. I'm saying it's under enormous pressure. We still have attributes that other countries, would dream of. So you don't kill U.S. economic exceptionalism, but you could put it on pause as people try to figure out what the operating environment is.
Mohammed, we're 5-6 weeks into a new administration. Has that much changed that quickly in such a short amount of time?
So I think there's been lots of changes. Just go to Germany and see what's happening there. Look at the debate there. It's been a Sputnik moment for Germany in terms of defense spending, infrastructure spending. John, all I can tell you is that all the consensus trades at the beginning of the year have been upended. Every single one of them. Currency, rates, relative U.S. equity performance to the rest of the world. I can go across the board. Every single consensus trade has been upended. And that tells you that there has been significant change.
Which raises a question about how much this is a trade and how much this is a fundamental shift that can actually get implemented in economic data that takes time. And Stephanie, I would ask you that. How long is the transmission mechanism for some of these things at a time when there are some fundamental policy shifts that will take time to implement, but it takes an even longer time to ripple through the underlying data and the underlying sense of strength?
Yeah, it should take a couple of months for us to start to see it reflect in the data. Of course, for example, today, the February data looked just fine. The March data are going to start to reflect this, and I would expect in the next 3 months we'll start to see the real impact. So, for example, the impact from tariffs, that takes about 3 to 6 months to work its way into the CPI data. So that's when we'd start to see that. The payrolls numbers we're going to start to see in the next couple of months because a lot of the job cuts are fairly immediate, and then you'll see the government contractors as a result, the fallout from that afterwards. So I would expect in 6 months' time we'll see a lot more of this truly reflected in the data, but we'll start to see it in the next couple of prints.
Kathy, from an investment perspective, and Mohammed was talking about how the policy shifts have been pretty dramatic and the market is trying to be a forward-looking prognosticator. How do you make bold moves? Do you just hide out in cash? Do you keep your allocations? I'm serious. It's sort of such a volatile time with sort of the reality checks coming out where there isn't that much news in the economic data.
Yeah, I don't think cash is the solution. Because, that it gives you some optionality. So building some liquidity, I think, is a good idea. And I think people undervalue liquidity in their asset allocation when things are good. And we've had this long stretch of everything's great. And who needs liquidity? Now I think you do need liquidity. But we are also keeping our benchmark duration right at benchmark. We're not extending yet. We hope to see an opportunity, but there's too much noise right now to take that risk. And then we're staying up in credit quality because you just don't have enough excess return there to justify taking a lot of credit risk. And we don't know what industries are really going to get hit. Some industries are going to suffer. And we do expect some spreads to widen as a result of that.
Europe's had a long stretch of everything's bad, and that's changed pretty quickly. Mohammed, to come to you on that, I remember in early November, shortly after the election, You said to us on this program, that sucking sound you hear is capital coming in from the rest of the world into the United States. That sucking sound we heard this week was capital going elsewhere. And we've heard that a lot throughout the year so far. Mohammed, what do you think about that reversal in flows that a lot of people have identified recently, and how sustainable do you think it is?
So that reversal makes sense given what has happened over the last few weeks. Is it sustainable? I don't know, John. The jury is still out as to whether Europe is going to be able to go from words to actions. It's not easy politically. It's not easy socially. They have governance issues. So I'm not sure that the reversal sucking sound, if you like, is going to continue for a while. But I understand why, because there's been a shock to a lot of the conventional wisdom on the U.S. and on Europe.
Mohammed, has there been an end to the sucking sound from the United States?
We'll see the data. I suspect you'll see that there's certainly fewer inflows coming into the U.S. But has it completely stopped? I really doubt it. The U.S. has some attributes that are very difficult to mess up. So the U.S. is still, whether you want to call it the cleanest dirty shirt or whatever, but it's simply not as clean for outsiders as it was a few weeks ago.
But Mohammed, where was everyone? The president was talking about these policies for months leading up to the election, and then talking about these policies for months between the election and inauguration. Everyone knew what his plan was. Why is everyone shocked?
Sequencing, Annmarie, and you talked about it earlier today. So we know the 5 areas in which he's going to move. 2 are unambiguously beneficial to the economy. 3 have good and bad to them. There's a journey issue in those 3. And the hope and the market expected that the sequencing wouldn't be what it is now. What you're getting now is, okay, we've got to go through the detox, we've got to go through the little disturbances, and then we will get the good. The market expected the good to come much earlier, therefore offsetting the bad. And that's not what has happened.
Stephanie, you're nodding your head away as Mohammed's speaking. You agree?
Absolutely. We were expecting tariffs to become a bigger thing for later in the year to tie to TCJA. They're coming much earlier. This has a legitimate impact on the economy. And by the way, the uncertainty is even greater than anyone had anticipated. So to the point earlier on CapEx being sort of stalled out here, it's hard to make any investments when you don't even know what the tax rates are going to be from a tariff perspective. And then they change day to day.
We're reacting to the payrolls report. Next week is the CPI number. That comes on the 12th on a Wednesday. Mohammed, I want to come to you just on a final question. Secretary Bessent yesterday at the Economic Club in New York said he'd like Team Transitory to get the band back together at the Federal Reserve and look through any inflation pop coming off the back of the tariffs. I just wonder how you feel about Team Transitory getting the band back together.
John, I'll go back to what Stephanie said. There is price pass-through from tariffs. Companies are much more agile in how they think about passing on prices than they were before. So I think, if Team Transitory gets back together, I wouldn't have them commit to too long a playlist.
It's a good way of putting it, Mohammed. We'll leave it there. Thank you, sir. Mohammed El-Erian of Queen's College, Cambridge, on the Federal Reserve, on the jobs data and this market as well. And a special thanks to Stephanie Roth of Wolf Research and Kathy Jones of Charles Schwab. Let's get you up to speed on news elsewhere this morning. Some of your top stories in your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Let's just recap some of the most recent data. That U.S. hiring remained firm in February. Non-farm payrolls rose 151,000. That comes in just shy of estimates, the average of which called for 160,000 jobs added. The data for the prior month, that was revised lower. For the month of February, the unemployment rate did edge slightly higher to 4.1%. Elsewhere in corporate news, Walgreens Boots Alliance is going private. Sycamore Partners will buy the drugstore giant for $10 billion. The deal is expected to close in the fourth quarter of this year. The purchase price, an 8% premium to the Walgreens close price in New York. Shares have seen a steady drop in value over the last several years. Goldman Sachs is pushing managers to move away from expensive office locations. Dubbed informally by some as Project Voyage, the aim is to drive down costs and tap a pipeline of talent emerging in cheaper regions. The bank is telling managers in New York and London to relocate to Dallas or Salt Lake City or risk losing their jobs. And that's your brief, John.
Danny, thank you. Appreciate it. The opening about 42 minutes away. Equity futures on the S&P just about positive by 0.2%. Up next, we'll set you up for the day ahead. Chairman Powell's coming later, and you'll hear from the President of the United States from New York. This is Bloomberg. Don't miss this one. 20 minutes away. We'll be catching up with the National Economic Council Director Kevin Hassett in just a moment off the back of this payrolls report. 151K, really small downside surprise. No big headlines here. 160 was the estimate in our survey. Equity futures going into the opening bell on the S&P 500 shaping up as follows. Equities are just about positive still by 0.1%. On the Nasdaq 100 up by 0.2%. Your trading diary into the weekend and out the other side into next week at 12:30 Eastern Time. Remarks from Fed Chair Jay Powell. 2:40, President Trump signing more executive orders. Look out for that. Sneak peek of next week, Monday. A 2-day EU finance ministers meeting begins. On Wednesday, the CPI report, plus President Trump's 25% tariffs on steel and aluminum go into effect. On Thursday, PPI and another round of jobless claims. And on Friday, the US government shutdown deadline. Do we need to talk about that?
We do.
Can we avoid that?
I think it might be avoided.
Goodness me. Tyler Kendall joins us now from the White House with more. Tyler, welcome to the programme. What are you looking for throughout this afternoon?
Well, throughout this afternoon, we know that President Trump is going to sign some executive orders at 2:30 p.m. Eastern, and then he's going to address the White House Digital Assets Summit at 3 p.m. Eastern. We're expecting about 24 crypto leaders to be here, including some executives from companies like Coinbase and Robinhood. Yesterday, President Trump had signed a Bitcoin reserve that we know went a little under expectations from the industry. We'll be watching to see what he says during those remarks, as well as if those Oval Office remarks get opened up to the press, particularly on this jobs report. I'm looking forward to your conversation with Kevin Hassett shortly, because this White House is likely going to have to thread the needle here, right? Particularly as we've been discussing that there's going to be some weakness expected in the months ahead when it comes to the labor market. I'm not quite sure how you transition once from Biden data to Trump data, if you can really backtrack on that, although one Republican did message me after this jobs report broke saying that it's very likely that this White House will continue to blame structural issues on the last administration.
It's a great question, Tyler. And if you see Howard Lutnick, the Commerce Secretary, running around the White House today, you should ask him about this jobs report. Is it Biden data or Trump data? Let's talk about next week for a second. Are we headed towards a shutdown?
Well, Annmarie, President Trump has said that he has instructed House Republicans that he would like to at least see a continuing resolution through September. It does appear that they might be able to get on board with that, considering that Republicans do hold both chambers of Congress, although our reporting indicates that there will not be a plan until late in the week. I will point out that timeline that President Trump has outlined there, because it does indicate to us that Congress knows it's going to take a little bit of time to get through his other policy priorities. It appears Republicans would like to get the government shutdown off of the table for now, kick the can down the road so that they can start trying to focus on some of these fiscal agenda items, such as President Trump's tax cut plan that the president and this White House would like to see get through.
Hey, Tyler, appreciate your time and thanks for this morning. Looking forward to your coverage later on this afternoon. Bloomberg's Tyler Kendall there in the nation's capital outside of the White House. The week is not over. We've still got to hear from Chairman Powell later this afternoon and the President of the United States.
At a time when the takeaway from this labor market report was that the economy is weakening but not weak, and we now have more than 3 Fed rate cuts priced into the market through year end.
Do you remember that Oval Office meeting between the Ukrainian president and the President of the United States?
It seems like it was last year.
A week ago.
It feels like I was at the White House.
It feels like years ago.
Yep, I think we're going to age a bit.
What a week we've had. Look out for this a little bit later, 9:15 Eastern Time. We'll be catching up with Kevin Hassett, the National Economic Council Director. Sneak peek of Monday. Steve Chevron of Federated, Veronica Clark of Citi, and a whole lot more.
Welcome back to another BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. The stars are out Friday at the 5th major. Iga Swiatek begins the defense of her title as she opens up against the very talented Caroline Garcia. While on the men's side, top seed Alexander Zverev faces a tricky opener as he goes up against Talon Griekspoor.